Now, if you guys don't know who I am, my name is Ollie Trades, and I'm known for pulling off some of the most savage account flips in the industry. I flipped 3,000 to 150,000 on live stream multiple times. You guys can find those videos all across the live stream section in this channel, as well as detailed video breakdowns that I've done on that. And in this video, I'm going to be releasing the entire trading blueprint that I've used over the last 5 years to get myself from $11 in my bank account and knowing nothing about trading to over $2 million in trading profits, my dream watch collection, and overall just time and money freedom by the age of 22. And make sure you guys join the free Telegram, which I'm gonna link in the description, so you guys can see all of my trading outlooks 100% free every single week. And before we jump in, I just want to tell you guys, there is a bit of a mic issue on some of the videos, so bear with me. Best of luck trading. Let's get right into it. What is Forex? Foreign exchange, also known as Forex, is the exchanging of two different currency pairs across the world. This is done professionally by banks, institutions, and also by retail traders, which would be people like you and I. The Forex market has roughly $6 trillion in daily turnover, which in comparison to the New York Stock Exchange is much bigger, as they only have around 200 billion. The Forex markets open on Sunday at 5 p.m. Eastern and run all the way until Friday at 5 p.m. Eastern. Forex has no centralized marketplace, meaning that you don't have to trade only a specific window, but you can trade at any given hour across the 5 days of the market being open. And if you trade crypto, that is also 24/7. The Forex markets fluctuate in two ways: by fundamental analysis, which is the data releases that we're going to dive into, how to read them, what we should be looking for, and how they'll affect the markets, and also with technical analysis, which is identifying the patterns and the orders within the charts in order to create our predictions and try to generate profits from the market. Why should you trade Forex? Well, in my opinion, Forex is the most convenient thing anybody could do to make money, and it has such low entry costs. When it comes to trading, you can trade accounts as small as $100, and the possibilities to grow them are literally endless. It's also extremely easy to track because there's only 8 major currency pairs. These pairs are the Australian dollar, the New Zealand dollar, the US dollar, the Canadian dollar, the Japanese yen, the euro, the Great British Pound, and the Swiss franc. Since Forex is open 24/5, you can trade it literally almost any given time, and you can also trade it from almost anywhere as long as you have your phone. Not only that, but when it comes to trading Forex, you can make money when a currency pair is going up or down because you're always trading two things against each other, and you can decide to go long, meaning you're betting that your position is going to move upwards, or you can decide to go short, meaning you're betting that your position will move downwards. And my final reason is Forex brokers offer you insane leverage. I've seen brokers offer 1 to 500 leverage, meaning that your $1 is 500x for your buying power. When it comes to trading, there are 8 major currencies. These currencies are the Australian dollar, the New Zealand dollar, Canadian dollar, Japanese yen, United States dollar, euro, Great British Pound, and Swiss franc. From these 8 major currencies, you have 7 major crosses. What I mean by major crosses is when it comes to trading, we have trading pairs, which means you're trading one currency against another currency. And the 7 major pairs are any of those major currencies crossed with the United States dollar, such as GBP USD or Euro USD. These major crosses take up 85% of the liquidity in the Forex market. And this is because the United States dollar is the world reserve currency. So this means that central banks around the world are all reserving the United States dollar, making it the most important. So of these major currencies, I like to trade any major cross, meaning that if you have one major currency, you can cross it with another one, such as NZD JPY or Euro NZD. And at the bottom of this video, you guys will be able to download the list of all the major crosses as well. Trading terminology is very important, so make sure you guys write these down and study them. The first currency in the pair is the base, and the second currency in the pair is the quote. So when you're actually trading, you're trading the differences between the two. So if I'm looking to go long, it means that I'm looking to buy the base pair against the quote. Now, if I'm looking to go short, it means that I'm looking to sell the base pair against the quote pair. Every time you step on a broker, they have something called a spread. A spread is the difference between the bid and the ask price, meaning right when you enter a buy, you're getting in at the bid price. And if you want to sell, that's the price you're asking to sell at. So you would instantly be at that price. This is how brokers make their money because they're profiting off of the gap right there. So imagine you bought something for $10 and right away, that's your bid price. Now your ask price, once you own it, is $9. So you can immediately sell it at a $1 loss, but you're anticipating that this product is going to increase in value, such as to $13. So that way you actually profit $3. A pip is a percentage in point, and this is how we track the actual movements of each pair. A bull market means that the market is going to be appreciating or moving upwards, and a bear market is going to be a market that is depreciating or moving downwards. We remember this by bulls attack upwards and bears strike downwards. When you're in your trade, you have three values. You have your entry, which is the price that you enter at. You have your stop loss, which is the point of price that you decide your trade is no longer valid, so you decide to cut it there. And you also have your take profit level, which is the level that you believe your trade is no longer valid in profits, and you decide to secure your money there. There are three major Forex trading sessions. The first session is the Tokyo session. Tokyo session starts at 7 p.m. Eastern and runs all the way until 3 a.m. Eastern. Honestly, offers very low liquidity most of the time. Depends on variables from the Bank of Japan for most of its movements. And if you are going to trade this session, which most traders do not, I would recommend only eyeing the Australian dollar, the New Zealand dollar, and the Japanese yen during this time. The next session is London session. London session starts at 3 a.m. Eastern, but most people are starting to eye London session at 1 a.m. Eastern. This is when you start to see Asia session wrapping up shop, and then you start finding early moves to enter and see where London session could potentially go. During London session, you also have an overlap with the New York session from 8 a.m. to 11 a.m. This overlap causes two sessions, meaning that multiple banks and institutions are trading during this time, leaving the most liquidity in the market to be found during those overlap hours. London session is my personal favorite for capturing entries because it is just extremely clean, and you have the liquidity from the Asia session at the highs and the lows to be swept, and you also have the overlap, which causes a lot of volume in the market. And the final trading session is the New York session. New York session starts at 8 a.m. Eastern, but the New York Stock Exchange opens at 9:30 a.m. Eastern, which is when you see a lot of volume occurring across the charts. The New York session has some gigantic moves that occur due to the fact that the US dollar is the world currency reserve, and the US dollar news is going to be released during the New York session, meaning that the biggest fluctuations are dependent on the data of those releases. This is the best session for trading indices such as US 30, NASDAQ 100, and S&P 500. This is also a great session for trading gold and any US or Canadian pair. Also keep in mind that on Fridays, since this is the last session of the day, by the time the charts open for the New York session, the London and the Asian session traders have wrapped up their week, so it oftentimes moves very slow and is just waiting on these high impact news releases. Each currency pair has a base and a quote. The base is the first currency that occurs in the pair, and the quote is the second currency that occurs within this pair. The base is always valued at 1, and the quote is what one of the base is equal to, meaning that if Euro USD is valued at 1.08105, that means that 1 euro is equal to $1.0815. Another example is if NZD JPY is trading at 87.292, that means that 1 New Zealand dollar is equal to 87.292 Japanese yen. Currency pair movements are measured in pips. When we look at pips, it's always the number that's one off from right to left, meaning that if Euro USD moves from 1.08105 to 1.08115, that has moved up 1 pip, because the number that is one off of from right to left has moved up 1. In trading, we have two types of trades, going long and going short. Going long means that you believe the base currency will appreciate against the quote currency, or in simpler terms, that the chart is going to be moving up. And going short means that you're betting that the quote currency will appreciate against the base currency. In other words, meaning the chart will go down. Going long is also known as buying, and going short is also known as selling. When you're actually trading, there's a bid and an ask price. These are the two prices that a broker will offer you the currency at. When going long, you're getting in at the ask price and can immediately sell at the bid price. And when going short, you're getting in at the bid price and you can immediately sell at the ask price. The difference between the bid and the ask price is called a spread. This gap, known as the spread, is where brokers make their money, because they're instantly offering you a price, and right away, if you want to get rid of it, you are losing money. Meaning that the broker can get in at the bid price while giving you the ask price, giving you a worse entry, and they're profiting that little gap. For example, if Euro USD has a bid price of 1.08110 and an ask price of 1.8105, that means you have a half pip spread. In other terms, imagine you bought a shoe for $100, and if you want to sell it immediately, it's valued at $90. You're not going to sell it immediately, but you bought this shoe at $100 anticipating that price will go up, meaning that in order for you to break even, price must cover that gap, aka the spread, and meet you at $100, and anything over that, you profit on the shoe. So in terms of trading, when you get in, price has to cover your spread. If it's a half pip, then price must move half a pip in profit for you to be at break even, and anything after that is actually what you keep. Each currency has a different spread, as well as the broker you trade on will offer you different spreads. Lot sizes are how we calculate the number of currency units that you buy or sell. One standard lot is considered 1.0 lots, but this represents 100,000 units. Traders can still trade mini lots, which are 0.1, which represent 10,000 units, and also micro lots, which are 0.01 lots, which represent 1,000 units. This offers us flexibility in our risks to make sure that we don't blow our accounts. Now, I know the numbers sound big, but they're really not. You have to understand that when we're trading, we're not taking something from $1 to $100. We're taking a price of, for example, 87.200 to 87.250. That small gap right there is what we're looking to profit off of. So that's really 5 cents in real life, but you can still make an insane return on just that move. Now, when it comes to calculating lot sizes, I recommend using a position size calculator such as the app Stinu, because it just makes it so much easier. All you have to do is put in your account size, the percentage you want to risk, and the amount of pips in your stop loss, and then you just select the currency pair you're trading, and it will tell you exactly what to put in. Now, the reason why we're able to make such big returns is because we're going to trade on leverage. Leverage is what the broker matches your deposit to be. So essentially, imagine you have an account with $1,000. Trading $1,000 on your own money would only allow you to open a 0.01 lot. That's 1,000 units. Now, this means that you're really not going to see any returns when price is being moved. Versus if you are on 1 to 500 leverage, now you're able to open trades up to 500,000 units if you're on 1 to 500 leverage. So imagine you're trading Euro USD on 5 lots and you catch 20 pips. Now you've just made $1,000 on your $1,000 account. But keep in mind, what you can gain, you can also lose just as fast. And that's why we look for a risk to reward approach. Meaning if I'm looking to lose $100 on this trade, I'm looking to gain $300. So that way my wins always outweigh my losses. When it comes to trading, there's a couple types of charts. The most commonly used, and the one that you guys have most likely seen if you've seen anything trading related, is the candlestick chart. Now, what these bars actually represent are how much price has moved on a given time frame. So you're able to navigate through these charts based on whatever time frame you select, whether it's you want to see one candle equal 1 day, one candle equal 5 minutes, one candle even equal 5 seconds. So we use different time frames to help with our analysis. The next type of chart is the line chart. So this one removes the bars and pretty much just shows you the overall direction of the chart. This is really good for beginners when they're struggling to find out the direction of the market, and is a good tool, especially when drawing your trend lines, which we'll get into later during this course. The last example I'm going to talk about are bar charts. Bar charts are very similar to candlestick charts, but they don't have actual body closes. They look more like ticks, as you guys can see here. As you evolve as a trader, I don't believe that you need anything except for the candlestick chart, and that is the one that I mainly trade on and we will be focusing on in this course. There are 2 main analyses that we need to do when it comes to trading. The first one is our technical analysis. Technical analysis is the act of using historical data on the charts to predict what will happen in the future. The second kind of analysis that we need to do is our fundamental analysis. Fundamental analysis is when we review economic and political situations of each currency to find out what the markets are pricing in. And what I mean by pricing in is, why is the market going to create the structure it's making? It's going to be based off of the data that we see from these areas. Some examples of data that gets released that creates our market structure is inflation data, unemployment rates, interest rates, core price indexes, and many more. All fundamental news releases that you need can be found off of forexfactory.com, and as well the link, of course, will be below this video. Before we get into the actual charts or explaining how we're going to trade, I just want to let you guys know what our trading style is. Our trading style is high time frame supply and demand, and And what I mean by that is I'm going to be looking at daily levels or weekly levels. That way it holds the strongest value, as well as doing my fundamental analysis to find levels that are priced into the market to validate these zones. When you have these two things in line, it creates the highest probability order that you can find. And it also takes away a lot of the stress, because instead of needing to sit there for hours at a time, you can sit there for a couple minutes in your session, set your alerts on your chart, come back when you receive your alerts, and enter your trade and let it play out. Now, the reason why I trade like this is because I trade all 27 major crosses, meaning that I don't need every single pair to set up today or tomorrow. I just need one or two of those 27 to set up across my week if possible. And if they don't, then great, because I know that next week one of them will. But there's such high probability trades that I'm able to risk more and leverage my money the right way to grow my accounts in the best fashion. Welcome to level 2 of the blueprint. In this section, I'm going to be showing you guys exactly how to set up everything you need in order to be ready for the charts. So I'm going to show you your TradingView setup, your broker account setup, and any tools you need in order to succeed on your trading journey. Alright guys, so now what we're going to get into is our TradingView setup. So the first thing I want you guys to do when you head to TradingView is just set up the colors the same way I do. So this is what I do for, nighttime. I don't like my eyes to be strained. So all you have to do is double click on any bar right here. And the next thing you're going to see is symbol. So I have my body set to this color over here. The blue, or I honestly have a custom one. If you guys want my exact one, this is the value. And then I have my pink one over here for my bearish candles. So any bullish or buying candle I have is blue, and any bearish candle I have is this pinkish red. Now I do the same thing for the borders and the wicks, just so that way they're all in the same alignment. Up next, I have the status lines. You guys can just copy everything I have here. The scale lines here, the way I have it is black, 100% opacity, and the smallest thickness. I also have the countdown to bar close right there, and the plus button is for alerts. For my canvas, I like to make my background solid, and I like to use this gray as my background. I feel like it's really easy on my eyes and it blends well with the colors. And then I just go to the opacity on my vertical and horizontal grid lines, and I turn them all the way down. Now my crosshair, I make it this gray right here, and I set it to 60%. And then I have my navigation visible on mouse over. If you guys look at the trading, this is what I have. This isn't too important. These aren't really things that you're going to use. And if you look at economic events, I do have these on right here. So that's the first step of this section. Now the next step is I want you guys to go to the time frames by clicking this over here and putting a star next to the 1 minute, 2 minute, 3 minute, 4 minute, and 5 minute time frames. Then you go down and you put a star next to 15, 30 minutes, and then you go to 1 hour, 4 hour, and 8 hour, and you put the daily, the weekly, and the monthly. These are the only time frames I use. I know it looks like a lot, but I promise you it's really nothing crazy. You're gonna skim through them in seconds. Now the next thing I want you guys to have is a favorites toolbar like this. So I'm gonna run you down through my section. The first thing I have is the crosshair on the favorites list. All you have to do is click the star here and it'll slowly generate this bar for you. Up next, I have my trend line, my horizontal line, my horizontal ray, and my vertical line. Going down, I have my Fibonacci retracement, which is honestly a tool I never use nowadays. Up next, I have my long position and my short position. Going further down, I have my brush, my rectangle, my path, my circle, and my ellipse. And then I also have the text and the call out. Each one of these tools is very simple to use, and when you have them here on your bar, all you have to do is click this button, and then you can go like this. Alright guys, so when it comes to actually using our favorites toolbar, there's a couple presets that you could put on that I have that just make it so much quicker instead of having to set up everything every single time. So I'm just going to run through them very quickly. Feel free to pause this video, take screenshots, and set it up the same exact way. So right off the bat, we have our crosshairs. That's easy. That just brings us back to this tool so we can move around if we're stuck using anything else. Also guys, I want to point out, I like using the strong magnet or the weak magnet here. Just making sure essentially that one of the magnets is on, so that way when I'm on the charts, I can have the most precise zones such as this, right? Instead of having to guess the actual levels, price will actually magnet to those points. As I was saying, we have our crosshairs, then we have our line here. Now this one is very simple. I'm just going to right click, and what you guys have to do is essentially just save as the same way I do here. So if you double click on this, I'm going to load my templates one by one. So I have break of structure bearish. This is going to be Very easy to set up, but it's just to identify when price breaks structure towards the downside, so we can have very clean and simple, easy to read chart markups. So I have break of structure to the downside. We have it on red 100%. Then I go to text. I have it on bottom center white text that's bolded, size 12. And as you guys can see, I have normal on the left side and an arrow on the right side. Up next, we have break of structure bullish, which is the same exact thing, just you switch the text alignment to the top. So all you have to do is hit save, save as, and save the name. Up next, I have equal highs, which is just a white line, as you guys can see here on the smallest thickness. It's just normal on both sides. This is supposed to be normal actually. And it just shows that you have equal highs resting at some point in the market. So in this example, it would be here. Now up next, we have equal lows, which as you guys can see is the same thing. We just change the text to lows and move it to bottom and center. Up next, we have liquidity, which I symbolize as just a bunch of dollar signs. This just shows me that there's an area in the market where we have a lot of money resting there and price is going to want a magnet too. And guys, just keep in mind, these are supposed to be normal on both sides. So same thing here, 12 text size on top, center, boom. Up next, we have liquidity cleared, which is the same exact thing. It's just I changed the text to an X. So that would show me that this liquidity has now been swept. So if I was on the market and I had liquidity resting right here, it would be a bunch of dollar signs. And then once it would be swept, I would then be putting my X right there. Up next is very simple. We're on to the last ones. It's waiting for break of structure towards the downside right here. It's literally just adding the words waiting for and waiting for break of structure bullish right here. Now I have the same thing for waiting for continuation of structure. So for example, if we're bullish on an order, let's say that we were in this right here, would be waiting on a continuation of structure. But at this level here, we would actually have our continuation, or you would have a break of structure first, which you would see as bullish, and then you would have waiting for continuation of structure. And if price went ahead and created this level here, then we would change this to continuation of structure. And I'm just going to save this as continuation of structure. And then you guys can see if I needed it bearish, I would then be changing just the text to the bottom side, and I would save it as continuation of structure bearish. And as you guys can see here, it's very simple. It's just this blue one with the second line thickness with an arrow on the side. So that's it for the first tool. Up next, I want to get into the rectangles. This one is very important because this is how we identify our zones. So the first one we have in the templates is the bullish zone / order block. And all I have for this is a 20% opacity on the blue color, right? Up next, I have the bearish zone / order block, which I have set to red and 18% opacity. So that way it's very easy to see. And then following that, all we have is fair value gap. This is going to be something that we identify in the charts, which is a big confluence to our trades. So I just have that as green and FVG. Up next, I have my short position, which you guys can see here. My stop color is red on 11%. My target color is blue on 10%. Up next, I have my long position, which I have my stop color set to this red again, 6%, and my target color set to 10% on blue. Following that, we have the ellipse tool. For this one, I just have it on purple, 23 opacity on the fill, and 100% opacity on the outside. Now I use this tool when it comes to identifying like big structure points, like this, just going like this to make it easy for my eye to capture it, but I don't use it all the time. It's something I very rarely use. Up next, I want to show you guys the horizontal line. This is a line that just goes to the right. And I pretty much just use this for when I'm looking at historical data, such as big liquidity points, maybe something like this, because I can't see my full screen. So then I can come to the side and see later on if that level has been swept or not. Up next, I have my horizontal line, which goes all the way across, which I use for very big structure points or take profit levels, which I just have as green because it makes it very easy. If I just right click on this, I can add an alert. I'll show you guys right now. I can add an alert so that way price, when it hits that line, I know my take profit has been met. Up next, I have the prediction tool, which I like to use when I'm setting up my orders. So for example, if I was eyeing this bearish order block over here, I would go like this. Then I would set up my bearish zone order block, and I would be predicting that price is going to come in here, create create some sort of break of structure towards the downside, and then continue to move lower. It's a very good prediction tool to see how accurate you could be. And if you even want to add on to it, you could add this tool here now and then show where your target would be. Following that, I just used the brush. I just have it on white and 4px. And then the call out tool is what I use right here. I have it in purple with just white text set to 12. So that way I can put my markups here and explain like exactly what's going through my thoughts on those markups. And I have the ellipse tool, which I honestly never use now, but it's very similar to this tool. I just prefer the one that's already filled in with the color and you don't need to like create more structure towards it. And then I have my horizontal lines, which I just have as red and dotted right here, as you guys can see. 2px dash lines, and then it's just red on this one. So this is, sometimes I use this to identify zones. Like if this was London session, I would just put that around that so I can identify, okay, everything within here was the movements of London session. And the final tool we have is something that I don't really use anymore, but it is the Fibonacci retracement. So you guys can see right here, these are my values. Take a screenshot, record them, whatever you want to do, but just make sure that you input these same values. And yeah, that's it for this video. I hope you guys get your TradingView set up, and let's get right into the next one. Now guys, in this video, I'm going to be showing you very quickly how I use Stinu to calculate my positions. As you guys can see here, let's say I just did a chart markup and decided I want to go short on USD/JPY, meaning I'm going to sell. If I use my tool to figure out how many pips my stop loss is right here, this candle over here, and keep in mind I'm on a 4-hour time frame, so if we move to the minute 15, you guys can see we kind of created a new high over here, a potential high. It's not a high unless we break this low, but let's just say that that's my stop loss. That would be 97.5 pips. So let's say I have a $10,000 account and I want to risk 2% on this trade. Now I put 97.5 pips, which by the way is a huge stop loss. I would go to that, click next, put in USD/JPY, calculate, and it would tell me, boom, I have to use a 0.3 lot in order to risk 2% on a $10,000 account, or a $200 risk amount. Same thing. Now let's say I'm trying to trade GBP USD, just to show you guys another example, and I want to go long from this range here, and that gives me a 22 pip stop loss. What I would do is put over here 22.4 pips, put in GBP USD, and hit calculate, and now I know that I would have to use a 0.89 lot for this trade. All right guys, now the final piece and tool that I want to show you guys before we actually start learning how to trade is forexfactory.com. This is where we find our high impact news releases, and it's very important that you guys stay on top of this. So all you have to do is go to forexfactory.com. I'll obviously have the link below this video as well, and you guys can see here all the news events coming up. Now, anything that's yellow isn't really something that we have to worry about. You always want to keep in mind if there's a bank holiday, which will be shown as gray. What's really important to us is red folder. Red folder means that we have a high impact news release, and this is going to make the market most likely fluctuate very heavily. Now, one simple thing we can do is if we come over here, we can click expected impact and filter it by only the high impact news releases. So that way, right off the beginning of the week, I can know exactly which news releases are coming up, and I can stay on top of that to make sure that I'm not getting caught in anything that would hurt my account and put me at more risk if I'm not ready for that. The broker that I use and I'm partnered with is 1xTrade, and I'm going to leave the link in the description for you guys to actually sign up under me, so that way you guys can automatically be entered into my trading contest. Now the contest is very simple. Every single 2 weeks, I give away $10,000, $5,000 to the trader with the biggest percentage gain on their account, and $5,000 to the person with the biggest profits made. The entry rules are super simple. All you have to do is deposit minimum $100, and you actually get unlimited retries at doing this. It's going to take you to this page, and you guys are going to sign up. I already have an account, so I'm just going to simply log in over here. And then from here, all you guys are going to do is click trading accounts, and you're going to open a new live account. Once you do that, select whichever account type you want. The standard account is very good if you have less than $1,000 deposit, but if you have a $1,000 deposit, I highly recommend the expert account. Now, me personally, I like to use 1 to 500 leverage, but whatever you want to use is going to be your preference. Simply hit create account, and then it's going to send you your account details straight to your email. From here, you go to the dashboard, and all you have to do is hit quick deposit, and then you'll be able to actually deposit or withdraw from your accounts. So here you guys can see it has my trading account selected over here. I have crypto deposits or credit card. And if you guys want a 250% deposit bonus, meaning that if you put in $100 on the broker, they'll give you $250 in credit to trade with. just simply type in Ollie Trades right here, hit verify before you deposit, and it will automatically do that once you put in your deposit. All you have to do at this point is simply input however much you want to deposit, select the type of deposit that you want, and then hit deposit into trading account, and it'll ask you these questions. Now from there, you go on your phone and you simply log into your trading account, and that's how you'll be able to input and exit out of your Forex trades. And now let's dive into the actual strategy that we're going to be using to take all of our trades. And so the app that we're going to use to be trading is called MetaTrader 5. And all you guys want to do when you're on MetaTrader 5 is click settings, hit new account, and then add the brokerage you're going to use. Simply type in your login right there. And once you're logged in, you'll be at a screen like this. So here I can see all my live accounts. If I want to add any currency pairs to this, I just simply search. I can either go to data feeds, Forex pairs, Forex market, and add all of them manually, or I could just simply search for whichever pair I want. But from here, you guys have two options. You can either come over here and hit chart, and then you can click this little button right here. And what that's going to do is it's going to allow you to either place a buy limit, a sell stop, a sell limit, or a sell stop. And then from here, all you have to do is set your stop loss levels and your take profit levels, and then just hit next. Now, once you're at this screen over here, you're going to see where my number shows 4.05. Just like I showed you guys on Stinu, for that one trade, it would be a 0.4 lot size. And all I have to do is simply click where my lot size is right there, and I can very easily change it. Now, another way to enter whatever pair I want is simply by going to the trade tab, clicking the plus in the top right. And then if I want to change my pair, all I have to do is click on the pair name at the top of the screen and then find whichever pair I want. So let's pick GBP USD. But let's say I want to sell limit. All I have to do is click that drop down menu and go to sell limit. Let's say I want a market execution, meaning I'm going to enter the market exactly where it's at. All I do is click that. And then I can either manually enter my stop loss and take profit values, or I can just leave these blank and hit buy or sell, and it'll enter me right away. Now, what you guys can do, let's say you only want to close half of your position. All you do is you come over here and you hold on whichever pair it is, you hit close position, and now it takes you to the screen. So I'm 14.5 lots deep on USD JPY. And if I want to go less than that, all I have to do is delete this, and then I can remove 5 lots if I want to. And if I really even want to, I could remove 0.01 lots from this order. And it's really just that. What's up, traders? Welcome to level 3 of the Pivot Dip Blueprint. And in this section, we are going to be getting into the charts and how we actually trade on a weekly basis. Stay tuned, take some notes, and always remember to pip and dip. So to begin, we have to talk about the 3 types of markets. When trading, we have uptrending markets, consolidating markets, and downtrending markets. Now, what do these mean? Uptrending markets are when the base currency is raising in value against the quote currency, meaning that the chart is overall moving up. It's very easy to notice because you'll see price start to move like this, where you have a low, a high, a higher low, and once that previous high is broken, we create a higher high, so on and so forth. So you'll see low, high, higher low, higher high, higher low, higher high. When trading in uptrend markets, our job is to manage to get in during these pullbacks, aka our higher lows. If price were to stop creating higher highs and higher lows and start creating equal lows and equal highs, as you guys can see here, we would consider this a consolidating market. In this point, there's an equal amount of buyers as there are sellers at the top and the bottom, and the markets are bouncing around these 2 levels. Once we finally get a break towards the downside, that would be a break of structure towards the bottom, and you would see you now have a high, a low, a lower high, lower low, lower high, lower low. This signifies a clear downtrend. Downtrending markets, we're looking to get in on the pullbacks, aka our lower high levels. An easy way to spot these trends are to click this candles button over here and move to our line chart, which we had talked about. From here, you are no longer seeing bars, you are seeing very clear price action in a line format. So it's easier to see where the exact high points and low points are. Now let's show you guys some examples of this. Here you guys can see NZDCHF, and I'm on the daily time frame. And one thing I want you guys to do is whenever you hop on the charts, do your analysis on multiple time frames. The idea is the higher the time frame, the stronger your analysis is, and you want to find a way to bring a higher time frame order and then scale all the way down to a lower time frame order where you find the transition or the break of structure to now where they're in alignment. So for example, what you would want to be entering on is something that looks like this, where the higher time frame is bullish, okay? But you're getting in on this pullback. So this is, for example, the daily time frame right here. Now, if you're looking on the minute 15 time frame, you're gonna see that price is actually trickling down like this. And that is essentially us looking at this level here. Now, what you wanna see on the minute 15, for example, is price break its structure towards the upside. The reason we would have a break of structure is because price would then be breaking a previous high to then shift its structure. So now it was moving from a downtrend into an uptrend. So you guys can see that very clearly here. This would be considered a break of structure. Now, if this is in alignment with our higher time frame, we can look to get in on a pullback. And now if we're moving long, we'll have a continuation of structure, as now we are continuing our uptrend. So the same thing goes if we were in a bearish order, right? Let's say on the daily, we're moving bearish, and next thing you know, we're back in this phase here. What we would want to see on like a minute 15, 5 or hour time frame is price trickling on its way up. Then we want to see price break structure, and I want you guys to know the difference between breaking and continuing structure. That's why I keep emphasizing it. Breaking is when we have shifted out of our complete structure. For example, here we're shifting from uptrend to downtrend, and now I've shifted. So I'm looking for this pullback. This is a potential lower high, and this lower high is confirmed once we create our lower low, because now I know this is the deepest area price pulled back into. So at this point, we would have our continuation of structure. Now, as I keep saying, and this is only because it's so important, we want to make sure that we have our higher time frame and our lower time frame in the same order. The reason being is, imagine you have an order on the daily time frame, and you're going to enter all the way up here because this is where you get your confirmation. If you were to take profits at this level here, you're at just about a 1-to-1 risk to reward ratio. But if you could somehow find a way to get in early by refining on your lower time frames, and for example, get in down here, your 1-to-1 risk to reward ratio has now turned into a 1-to-3, meaning if you risked $100 on this trade, you would profit $300. So I want to point out some examples and some really easy tricks on how we can identify market structure. So the first thing here on this candle chart is you guys can clearly see price has low, high, lower low, lower high, lower low, lower high, lower low, lower high. This is a very clear sign of price continuing its structure on downward. Everything here is continuing, there's no breaks. Now over here, we have 2 equal lows. This is a significant point because the market is showing that it's struggling to break here. So this is a great example of continuing structure towards the downside and then creating equal lows. Now I want to show you guys another example. Let's just keep going left. So here you guys can see we have a very clear downtrend right here. Low, high, lower low, lower high, lower low, lower high, lower low, lower high, higher low, higher high, higher low, higher high, higher low, higher high. So as you guys can see, our structure completely breaks over here, and then it starts to move bullish and continue its structure as price continues to move up. Now I'm just going to hop on another pair just to show you guys how we can execute this drill. But another thing I want to point out is, let's say you come over here and you click this, you can actually change it to the line chart, which shows you very clear data points in a line format instead of those candlesticks. So it makes it a lot easier to see structure. So as you guys can see here on EU, you see high, lower low, lower high, lower low, higher high, higher low, higher high. So you would have your break of structure at this level here, which is when price is now showing us that it's going to shift from a downtrend to an uptrend, or vice versa if we see it occur the other way. So let me show you guys just one more example of that on the line chart. Price pulls back, lower low, lower high, lower low, lower high, equal low, higher low, higher high, higher low. Now, if you guys identify the structure points here, here is a continuation of structure, another continuation of structure, and then finally at this point here, we have broken out of the downtrend, signifying that now we are in a break of structure. And then at this point here, we have now created a continuation of structure because we have now continued the bullish structure. And guys, this method you can use across any time frame, but obviously the bigger the time frame you guys use, the better it is. And we always want to make sure that our higher time frames are in alignment with our lower time frames, which we will get into in one of the next videos. When it comes to trading, we have macro and micro structure. Macro structure is considered the higher time frames, such as the daily, the weekly, and the hour 4, while micro structure is considered the smaller time frames. In my opinion, anything from the hour 1 to the minute 1, I consider micro structure. Both of these are valid and are very dependent on what type of trading style you have. I have begun to swing trade because I like being more patient and finding one very probable setup which I can attack very hard on in order to leverage my capital and turn it into something much more, versus versus being more aggressive and taking lower probability trades, trading more often, and leaving myself to more exposure. So the way I like to utilize these is making sure that my macro and my micro timeframes are in line. Now let's dive into some actual examples on the charts. So when we're actually on the charts, we always want to make sure that we find our orders and validate them across multiple timeframes. Well, for example, I'm currently in a USD CAD trade. This trade I started on the daily time frame, and as you guys can see, I had this level over here that price was holding into. Now, when I go on my weekly time frame, I can see that this level is equally as valid on my weekly time frame, meaning that macro, I believe this price is going to move bearish. Now, when I go on my lower time frames, I'm seeing we are super bullish right now, right? The 4 hour right there, the 1 hour is bullish, but then I start making my way down. And now here I'm on the minute 15, and I can see price has broken structure towards the downside here. Price has pulled back, continued structure, and now it's pulled back into that area and it's respecting the structure, looking like even on the lower time frames, we are creating lower lows, lower highs, and lower lows. So I'm expecting price to continue on its way down. Now, if this was solely a minute 5 trade, as I'm on the minute 5 time frame now, I would be looking for a minute 5 take profit. But since I can share the stop loss with my daily and my weekly zone, this has increased the strength of my trade, the probability, and now I can use that time frame's take profit level to my advantage. So now instead of taking a minute 5 take profit level, I can go on a minute 5 entry, but still find a daily or weekly time frame take profit level. So you guys can see here, instead of securing what would have been potentially a 1-to-1, my entry for this trade is right here. So it would actually be a 1-to-5 risk to reward ratio just about. And that's because I'm just using these equal lows on the daily time frame. Now here, let's go to Euro JPY. If I go on the weekly, I can see that price was extremely bullish for so long. Then I drop down to the daily and I see price was extremely bullish, but recently has been moving bearish. And it's falling down with such aggression. I mean, you guys can see here, it's like building steps up, but here it's just straight skydiving downwards. So then I go to my hour 4 and I can still see all of these time frames are in alignment of bearish movement. So until the market would give me something such as the lower time frame starting to trickle up like this, then I could start to look, okay, if I reverse engineer this, are we holding any zones to previous data that would then be allowing us to push higher up? So I want to show you guys an example that's obviously played out already and which price moved in this fashion. If we bring price back to here, you guys can see we were taking steps heavily upwards and then we pretty much jumped out the window and fell. Now price decided to hold on to this level here, and if you go on your lower time frames, you're going to see it starts to trickle up and trickle up slowly and give us these confirmations that price is going to want to continue. So here you guys can see we broke structure on the hour 1, we retested, and we broke structure again. So if I'm catching a late entry right here just because of how high the time frame of this order is, right, as we were on the daily, and now I'm expecting to create a new high, just by being patient right there, I'm able to get in and secure this move right here. Obviously this is a daily time frame, this is taking a lot more, but I'm trying to show you guys the strength of the macro time frames and aligning them with the lower time frames. So now I was able to catch that move right there versus having to just take a gamble on this entire zone without waiting for confirmation and waiting for price to break all the way up to here, which wouldn't even lead me to a 1-to-1 risk to reward ratio. Now, one example I want to show you guys is higher time frame versus lower time frame. I want to show you guys this example on Bitcoin. A lot of people had believed that Bitcoin was going to keep moving bullish here because we broke structure, create a higher high, higher low, higher high, higher low, and higher high. But what I was seeing here is the macro picture, right? So on the hour 1, we looked extremely bullish on this time frame, right? So here, this looked like a perfect entry for a buy. I mean, we just cleared this high, we closed very strongly above. But when I go on my daily time frame, I can see that overall, we're moving sideways, but we're still trending down. Now, this is an important thing, is sometimes the markets consolidate or move sideways, but we want to identify the direction that the sideways move is going. So here I can see that we're still moving down, and this is a significant push towards the downside on the daily time frame. So I have the daily time frame push down, and I have the hour 1 time frame push up. The daily time frame, think of it like this, consists of 24 1-hour candles, making it 24 times as strong as that one candle, making this order for sells a lot more valid than the order for buys. Now, the way to catch the perfect entry on this is by waiting for the lower time frames to now fall in alignment with it. So you guys can see here, price starts to slow down and it breaks structure over here. This is just strictly on the hour 1. So after we've reached our daily zone, we can see the hour 1 broke structure. You could have taken an aggressive entry and tucked your stops right above here. And guess what? Since you use the daily time frame for your confirmation basis, it's almost like you're entering the daily order, but just after receiving a lot of drawdowns. So you're getting a better entry, maximizing your risk to reward. So in this case, instead of catching what would have been a 1 to 3.6, you have now caught almost a 1 to 8. I hope this clears up macro versus micro structure for you guys, and let's get right into the next video. Finally, we have reached the point that I think is the most important part of trading, which is order blocks. Order blocks are levels of supply and demand in the market that just simply signify a point of interest that we identify by looking at the lowest or highest points before breaks of structure in the market. Every time I step on the charts, I'm looking for order blocks. And I always like to find order blocks on the daily time frame and then refine them all the way down. So for example, the reason why I took this USD CAD trade is because if I go to my daily time frame, I can see that I have an order block resting over here. The reason that this is an order block is that this is the last candle that price is at before it makes this huge break towards the downside. Now keep in mind, this is on the daily time frame, so this holds an extreme weight. Now what I like to do next is switch from the daily time frame to the weekly time frame and see if it's valid there. So here I can see this candle over here break structure towards the downside, and so in that representation I'm still seeing it valid on the daily and the weekly. Now what I wanted to do was go on the minute 5, minute 15 or something and find a way to find a break of structure and a retest onto an order block. So in this case, I went to the minute 15, and you guys can see you have a break of structure over here, and now what we're left with is an order block resting right here. Now watch how cleanly price taps in and then tanks down. Here's another example, Euro NZD. We actually smashed some sells last week from this move, and as you guys can see here, it is the same exact setup. This setup prints in the market all the time, and I swear to God guys, this is the holy grail to trading. You guys can see here, this order block is the last candle before this huge move towards the downside. So I see it on my daily and I identify it. Then I move to my weekly time frame just to make sure that price is in alignment with that. So you guys can see here, price still holds on the weekly. It looks extremely valid for that. And now what I wanted to do was make sure that on my lower time frames, I was starting to trickle down and pretty much find my macro structure in alignment with my micro structure. So here you guys can see price starting to slow down. After it creates this higher high, it starts to create just some consolidation in this range here. And if you trickle down to your time frames, you're going to see on the minute 15, we have an order block that was resting up here. Price breaks structure, taps into it, continues structure, and then I get in on the retest of this order block resting right over here. So for me, order blocks, once again, are the candles that cause the big push towards the downside. So you guys can see on even just on the minute 15 here, we have this candle, it creates this push towards the downside. We pull up, touch in, and this candle is the highest point that we reach before creating this push to the downside. Then price pulls back up and continues further down. So you guys can see now we have that zone right there, and that zone has even been tapped into right now, and it could potentially still play out. Although price has moved so far away from our entry and already hit our daily take profit level that I wouldn't necessarily be looking to take this exact trade, but possibly I would if I found further confirmation. Now, one thing I want to go over with you guys are my rules for order blocks. When it comes to order blocks, I have a very simple set of rules that you guys are going to see right here. So make sure to screenshot them and take notes or whatever it may be for you to remember them. But when you have a bullish order and you have a bullish candle as your order block, you use wick to wick. And when you have a bearish order and you have a bearish order block, you go wick to wick. Now, once again, on a bullish order, if you have a bearish candle as your order block, you're going to go candle to wick. And on a bearish order, if you have a bullish order block candle, then you're going to go body to wick. I hope you guys enjoyed that. I hope this clears up some things about order blocks for you. And let's get straight into the next video. All right, guys, in this video, we're going to be covering fair value gaps. Fair value gaps are areas in the market and where we see insufficient price action. And what I mean by that is the market is moving in a way that it should not be moving, which shows us that the market should go correct this area. It's essentially a hint that the chart leaves for us, showing us where in the future it'll return to. When it comes to trading, this is how a fair value gap looks. We have 3 candles. The first one leaving 2 small wicks, the second one with a very big body, and the third one leaving 2 small wicks. Now, as you guys can see, these 2 wicks don't touch each other. Now, this is very important because across the markets, each wick, if you guys check through previous data, essentially covers one another. And when you see that they don't, it shows you that price is going to one day return and fill that in. Now, just because price has to return to these levels doesn't mean that it's going to happen now. But if we use this with our other confluences that we learn in this course, you piece them all together and it helps you build a stronger case for your setup. Here I'm on the 4-hour chart on Euro CHF. As you guys can see, I'm going to start pointing out areas where we had fair value gaps. So our first one is going to be right over here. This over here, as you guys can see, was a fair value gap. And for this, I'm just going to use my FVG template. Price had left this big body over here, small wick and small wick. So price hadn't touched over here. Now, this to me was a sign that price is going to have to come back into here at one point in price. And if it does, and my other confluences are in alignment, then I could be taking this further down. So as you guys can see, very simple. Price comes in, fills it, and then makes its big drop towards the downside. Another example is over here. You guys can see price, first candle, second candle, and third candle. So here's your first candle to touch your third candle. That is the gap over there. So price starts to stagger over here, and then it touches in, fills in your fair value gap, and gives you a big push towards the upside. So fair value gaps to us are always going to be used as levels of confirmation. If you see this, it's going to be a very good confirmational bias to enter a trade, as long as you have other things in alignment with it. So I'm just going to start pinpointing all these fair value gaps that you guys can see over here, and you can watch as they all get filled in. So here's another one that gets filled in. You have another fair value gap resting over here, and it gets filled into, and this is all just on the 4-hour time frame. And here I'm actually going to switch pairs and just show you guys how these work on other pairs. So here you guys can see we have GBP CAD on the hour 4 time frame, and we have a fair value gap resting over here where price needs to touch. Later on it comes down and it fills that. We have a fair value gap resting right here. Price later on comes in and fills it. And in today's current market, we have a fair value gap resting right here. And since price is breaking structure over here, this is actually something that I would really like, because now, for example, guys, this is a very brief way of how we can piece together all of our confluences. You can see price would break structure over here. We would have a fair value gap for price to enter in on. It would pull back down and then potentially give us a confirmation in this area. And that would then lead us to believe that this could continue and continue an uptrend. Here, I'm going to go on one last pair to show you guys just fair value gaps and how they are respected on the charts. And then we're going to move on to our next section. So here you guys can see fair value gap over here. Price leaves this big imbalance, but it has to come back into it. Once again, we have a bullish fair value gap over here. Price goes into it, taps in, and then continues upwards. Here you have a fair value gap resting over here. Price comes back into it and essentially rips through it. Then you have a bearish fair value gap over here. Price is going to later on magnet into this area. So now this is one thing I do want to point out. If we are moving bullish now, as you guys can see, it kind of looks like we're creating a high, a higher low, a higher high, higher low, and potentially want to create a higher high. So now we've respected this fair value gap. Looks like we're moving upwards, and I want to find a target in the charts. Well, this fair value gap area can be considered as a target for where price needs to go. So we can use them not only for entries, but also for confirmations when it comes to that. But more on that in the next video. Alright guys, so in this video, I want to explain how we can not only use fair value gaps for our entries, but we can also use them as target points in the market. If you guys look over here, this was the last example that we pointed out, where you have a fair value gap that we could have used to potentially get in to continue our structure here. And then we have a fair value gap where price might magnet to. Now, what I want to do is show you guys examples where we're able to use both sides in order to catch a take profit or something along those lines on the charts. So here on Euro USD, I already want to point two things out. If you guys look, when price was moving bullishly, we left this fair value gap over here. Now price has broken up, came back down to enter where we were moving bearish, and has left us this fair value gap over here. Now, if I wait for this to get traded into, one area that I could be looking to target is something over here. So let's just say that I set a sell limit over here on the 50% of the fair value gap, and I targeted this range right here. Now I'm gonna watch as price starts to move. As you guys can see, it literally taps in and comes all the way down. Now, one way you guys can find the 50% value is by using our Fibonacci retracement tool. So to me, a fair value gap is filled when we have touched the 50% value mark. Now, I honestly eyeballed this really well, but for future reference, always make sure to use the 50% value mark, because when our fair value gaps are filled in 50% of the way, that means that they have been traded into and that we can stop looking to use that level. Now, it doesn't mean that every single time it needs to retrace 50% of the way, but if you do see it retrace 50% of the way, then push out of that zone, then most likely it's not going to come back into that zone and give you any further drawdown. So I want to get into another example. So let's just go to a random moment on the chart. So here you guys can see that on Euro USD, price was moving very bullishly over here and left us this fair value gap. Now, if we start identifying when the shift in the market happens, it's when we start to slow down up here and then start to make our way back down. As you guys can see, at this point, what I want to do is find a fair value gap and look to take it towards the downside. So one fair value gap I have already has been right here. Now, if we trade into this area, then I could be looking to target this level down here. And then you guys can see, I mean, we do get a very brief touch in there. And if you are to enter off of this fair value gap level, then you could be targeting that lower level. And let's see, you guys can see price barely taps in. And so one way I would have approached this is if I did want to get in on this fair value gap, I would have gotten in right on the retracement and moved my stops right above it. Now, if price had moved 50% of the way, then I would have moved my stops to cover that level. So if price would have pulled back at least to this level over here and then made its way outwards, I would have then shortened my stop loss to cover that. But you guys can see it didn't. It just touches in and then it tanks towards the downside. So at this point, I think it's premature to shorten our stop loss because we still haven't even really filled in the fair value gap. So let's just let this play out a little more. Here you guys can see price starts to move a little lower. And also I want to point out this was also a bullish fair value gap that we could have been looking to trade into, which we would have absolutely destroyed there. And then you guys can see price, since it didn't move 50% of the way, still retest this level and then perfectly snipes all the way back down into that fair value gap. So let's go through one more example so you guys can really piece this together. So here you guys can see that gold is moving very bullishly. And right off the bat, I can see I have this bullish fair value gap here and this bullish fair value gap here. So if I am to get in on a bearish fair value gap, these are going to be two targets of mine. But you guys can see price starts to slow down and it gives us a very big push towards the downside, and we still need that third candle before we can find a fair value gap. So now price has literally ran through two fair value gaps without even touching this fair value gap it left on the bearish side. So now we're in a bullish fair value gap and we have a bearish fair value gap over here. Now the reason why I wouldn't want to buy back upwards is because I can see the strength from the sellers in this market. I mean, it's absolutely melted down. If you guys look at this, price took us 11 days to make the move towards the upside, and it took us 2 days to make that move towards the downside. So now I can remove that level because obviously been ran through. And what I want to do is try to get in off of the retest of this zone over here. If price wants to do its thing, it's, as you guys can see, it's already pulling back a bit. Then it breaks the zone, but then it pulls all the way back to the fair value gap and absolutely rips towards the downside. So you guys can see every single time we're touching these fair value gaps, it's giving us huge moves in the markets. Now, these are amazing for our entry confluences, and we're going to get into that in one of the next videos. I'll see you guys there. Alright guys, now in this video, I want to explain a super important concept in the markets, which is liquidity. Liquidity on the charts is essentially where the money is resting. Now, this is very important because it's going to show us target levels on the charts. Not only that, but it's also going to show us areas that we need to avoid getting into because they are weaker due to the fact that everyone is getting in there. So the way I like to view liquidity, as you guys can see here, is by viewing the wicks. Now, the wicks on the charts obviously are these little lines at the bottom of the candlesticks. So areas where I see more wicks overlapping with each other are areas that I see more liquidity. Now, the idea behind liquidity is if there's a lot of money resting there, price is going to want a magnet to it. Because if I am a multi-billion-dollar hedge fund or something that's trading on these charts, I want to be making the most money I possibly can. So I'm going to be targeting the areas with the most money in them. So we can draw liquidity in a couple ways. We can draw liquidity by identifying wicks as areas that are just overlapping within a flat line. So for example, here, if I were to identify liquidity, I could say that we had liquidity resting at the bottom of the zone over here. And I could also say that we had liquidity resting at the top of the zone, because the liquidity to me is always going to be pointed out by the wicks. Price is going to want to shoot all the way to the wicks and make sure that it sweeps out all the money on both sides. The idea is the less people in that position, the more money the few people who are in will make. So you always want to be on the side of the people who make the money, not the people who are getting their money taken from them. Now, another way that we can draw liquidity is just simply by drawing trend lines. So it could be a dynamic liquidity. Now, dynamic liquidity is something that builds up like this, where it's respecting this zone. So you guys can see there will be dynamic liquidity on the bottom, and there would also be dynamic liquidity on the top side. Those are the two ways that I like to draw my liquidity levels, because it essentially shows me where the charts are going to move to, and it gives me a better perspective on where I need to target. So in this video, I'm just mainly going to be drawing these liquidity levels so you guys can understand how I would do them. So if I look over here, this to me would be dynamic liquidity, and dynamic liquidity resting over here. Now, these are both going to be levels that want to be swept. And one important thing to note is you're going to notice when one side of liquidity gets swept, for example, over here, price is then going to want to later sweep all the other dynamic liquidity. So if we broke towards the upside, sooner or later, we're going to break towards the downside as well. Now, you guys can backtest this as far as you simply want, and you can also do this on all time frames. So I've been doing most of the work here on the daily time frame, but for this video, I'm actually going to shift down to the 1 hour time frame so you guys can understand what I mean. So here we have CHF and I'm just going to pick a random moment from it and show you guys exactly how we could have taken liquidity towards our advantage. Right here, you guys can see we were moving very bearishly. Now, what I noticed right away is we have some dynamic liquidity resting right here. And then we also had some liquidity resting towards the bottom over here, but it was swept. So if one side has been swept, then more likely than not, on the next approach, we're going to sweep the other side. So you guys can see here, if I am correct, then price would break through and sweep the dynamic liquidity resting on the top side. So what you guys can see here is price breaks through, and we could even take, for example, a trade just off of the break right there. And then we could target the rest of dynamic liquidity, which would have been absolutely smashed there. Now let's get into another example of this. If I were to go all the way to back here, and I hope you guys are able to spot this yourselves, so feel free to pause the video at any moment before I give my example or my answer and see if you guys can spot the same liquidity as I do. There's a couple ways we could go about this. We could go about this dynamic liquidity over here, and we could also say that we had a lot of liquidity resting up here. So we had one big wick over here that pushed us down, a big wick that pushed us down, and then price respecting this level very heavily. Now, one thing you guys can see is price broke above, swept the liquidity. So when we sweep our liquidity, we actually can just use liquidity cleared, and that's an X on the chart. And then if we haven't swept it yet, then we can use just the liquidity. So that way we can know the difference between if it's been swept or if it hasn't. So here you guys can see we had a clear candle closure above there, and then we broke back into it. Now it's still building all this liquidity over here. So what I'm anticipating is when it finally does break, it's going to break and it's going to crash hard because there's all this money being built up over here. So when it does want to go take that money, it's going to move rapidly, so that way less people can take that same approach. Now, as you guys can see, price is essentially squeezing itself. Now, this is always the beauty of when you have a dynamic and a resting liquidity, is they essentially squeeze themselves and it forces it one way. So as you guys can see, price was squeezing its way out, which is one reason why I really like using a dynamic and a normal liquidity level, because it essentially causes price like a pimple, like you're squeezing the pimple and then it's going to explode everything that's inside of it. So here we swept the top, it's still being squeezed, and now it looks like we had a strong candle closure outside of the dynamic liquidity zone. So if I set my sells right here and I cover it right above, I'm going to now be looking for the target level. So obviously I have the bottom of the dynamic liquidity, but one thing that I've noticed by just years of trading is it's not always as cut and dry as just targeting the lowest point. I often realize that price is going to go towards one level, and that's where the wicks are all sharing each other. So the lowest point where the wicks are all touching each other would be resting right over here. So it would be the highest of the lowest point. Now what I mean by that is this wick is the highest wick that still touches all of the low wicks. So that's what they all have in common. So to me, my take profit level would be over here, and you'll notice that price is going to sprint towards that level and then it's going to slow down. And oftentimes, yes, it will still clear the whole thing, but I'd rather get in on the very quick move than have to wait for it to pull back on me, potentially reverse, lose out on my profits, especially when my risk to reward is something amazing like this 1 to 5.5. So here, if I hit next, you guys can see literally in a matter of 2 candles, this whole move was white, versus it took us 4 days and 20 hours to build all this liquidity towards the upside. And then just by being patient and ready to enter at the right time, we're able to see that price shoots all the way down and clears all that liquidity right away. And now let's get one more example so you guys can really understand this concept. So here I'm on CAD CHF, and I'm just going to pick a random moment so you guys can see what I mean. But if we go over here, we can see price is building up dynamic liquidity. I can already see this very easily because of all these wicks that are being touched. So if I'm able to draw a line and see price retesting and bouncing off it, I already know that price is building dynamic liquidity. Now, another thing that I see is if I move a horizontal line over here, price is building dynamic liquidity on a flat line. So this is like that pimple setup I keep talking about. You guys can see we have liquidity resting on the bottom and liquidity resting on the top. Now this is a very important thing. Now in order for me to get on buys, I want to see a clear candle closure break outside one of these liquidity levels. And the reason why I want to see a clear candle closure is because you guys can see right here, if we had the push above this level and I just got in before the candle closure, I would have been stopped out if I covered the previous low because I didn't wait for that confirmation. Now, if I'm going to take buys, I need to find a level that's going to make sense. So let's think back to our confluences. We have fair value gaps, we have liquidities, and we have order blocks. If I have an order block resting over here, that's one target that I could potentially see price going to. And I can also see that I have a fair value gap resting right over here. So just so I don't confuse anyone, I'm going to make this the order block template, bearish zone / order block, and I'm going to be waiting for either price to break above or clear itself out. Now the reason why I'm not finding an order block on the bottom side is simply because here I have dynamic liquidity, meaning that I want to target it based on the area that the wicks are all being shared. But on the top side, I have a flat liquidity line, which means that I need to find a different confluence to be targeting. So if I'm looking for my sell target over here, I want to find the lowest area where all the wicks are being shared. So to me, it would be this line right here, because I have 1, 2, 3, 4 touches right there on the lower end of it, and it's right above the bottom of this. Now, if this area wanted to hold, I'm still safe because I'm targeting an area right above it, and there's so much liquidity that I anticipate that it will still be held. Price makes its way towards the upside here, as you guys can see on that next candle. And if we zoom in, we do get a candle closure barely above the zone. But to me, it's outside of the zone, and I want to be entering this move. So the way I'm going to do it is by covering my previous low, and then I want to target a certain level. So here I can see that my risk to reward, if I take this buy, isn't good. So once I reach this fair value gap, I just want to set my stops to break even, meaning that if price were to come back to my entry, I wouldn't lose anything. I would just be breaking even. But if I target the order block, I have a 1 to 1.5, meaning if I risked $100, I would make $150. So to me, that order could make sense. So just like that, now my stops are set to break even. And as you guys can see, price makes its way towards the upside, and it's about to hit our take profit, and then it makes its way down. So at this point, I've just missed out on the move, whatever, that's okay. But I can see price is still respecting this trend line right here, and it's building more liquidity. So it didn't touch this order block, which is why I'm not ready to get into sells. But if we break towards the downside, I would definitely be looking to sell off. Now, as you guys can see here, now we have another wick, and I want to be patient. I don't want to get in too early and then have this push upwards and I lose out. So I let another candle play. And here, if I zoom in, I can see that price clearly closes right below that. So I can get in off of this move here, use a stop loss kind of aggressive right there if I really wanted to. And now I have my target level resting right here. Now this would play out for a 1 to 4.4, and let's just see how it goes. Price right away starts to make its move downwards, and just like that, you guys can see it literally smacks the take profit and moves directly away. Now this is what I mean by, yes, we can continue the whole move, but I'd rather accept a very big win, such as risking $100 to make 442 on a higher probability, rather than risking it more just to make an extra 200 bucks. This is just the mindset that I've reached because my account sizes have become much bigger. So I'm looking more to sharpen my win rate so I can continue to scale up my capital and make more money. Because when it comes to trading, it's not about needing a better skill set to make more money. It's just about finding profitability, and then from there you find ways to use more capital. Instead of having $100 on a 1-to-1, it's $1,000 on a 1-to-1. Now I'm going to show one more example because I feel like this was a really good one. It had everything. It had dynamic liquidity, still liquidity, fair value gaps, and an order block all resting in it. And I just want to show one more example so you guys can really dial in the concept of liquidity. So here we're on NZD CAD. Now I wanted to change the pair just so you guys can really see how well this works across anything. Now right off the bat, I can see price has this dynamic liquidity over here, and it has the still liquidity resting right here. Now once again, I just want to see a break above either one of these zones. Now if I'm going to take the dynamic liquidity, there really aren't many wicks touching each other on any of these levels. So what I'd want to do is go to a lower time frame, such as this minute 15, and try to find it there. But if I can't, then that's fine. I can just keep going down time frames, or if it really just doesn't look like anything is that solid towards the bottom, all I would do is then target the entire move towards the downside. So here I'm either looking for a candle closure above this zone, or I'm looking for a candle closure below this zone to then enter buys or sells. So if I just let this simply play out, you guys can see wick above, these aren't closures. So we don't want to get in because we don't want to be faked out of the move. Now here we can see a very strong sell towards the downside. So if I do that and I put my stops above that high that we just created, and now I target the low that we have here, that's a 1 to 1.4, almost a 1 to 1.5. And I'm down to take those odds because even over the course of 10 trades, if I win half of them, that still gives me very good profitability. Now you guys can see price starts to slow down towards the bottom, pulls back a little bit, but then eventually just smacks our take profit level. This is the power of identifying dynamic and still liquidity levels, and this is one of my favorite ways to find confluences across the charts. I hope you guys enjoyed that, and let's get right into the next video. Alright guys, so after all these lessons on the technical side of Forex, I want to touch up on the psychological aspects of trading. Now when it comes to trading, I know you guys are going to hear all across the industry that psychology is key, and it really is. Now when it comes to psychology, everyone has their own definition, and to me, it's how our brains approach the markets, right? So there are certain days where something external might be happening, and this could affect you when it comes to trading. So a part of your trading journey is literally going to be building a higher stress tolerance, because setting Staring at the charts for hours upon hours can get very tiring. It will get very tiring. Not only that, but sometimes you sit there for hours and you end up losing, which can lead you to feel angry, sad, depressed, and we have to make sure that we avoid these things. Now, when it comes to psychology on the actual charts, I'm just going to show you guys examples of exactly why it's important to stay patient. And guys, the mindset that we must adopt is I'd rather be the trader who misses one win and misses 6 losses than takes one win and takes 6 losses. So I know a lot of the times we want to look to enter the charts as soon as possible, but this is something that is going to hurt us in the long run. And something that's very important for when it comes to trading is we want to make sure that we have a risk buffer, whether it's a weekly or daily risk buffer, meaning if you lose 2 times on the day, you then stop at that point. Or if you lose 4 times on the week, you stop trading for that week. This is a prime way to make sure that we don't blow our accounts, because if you do that and couple that with proper risk management, such as I'm only going to risk 5% total a day and I'm going to risk that 5% across 2 trades, then you prevent yourself from losing at all. Now, the same way we want to protect ourselves on the downside is the same way we want to protect ourselves on the upside, meaning you should set targets for yourself. If you're trading and you have an amazing return on a trade, there is no reason why you should let that entire trade reverse on you, especially when the money means a lot to you. So I see a lot of people trying to flip accounts and they'll take their $100 account to $200 and they're like, oh, but it's only $100 in profit. What you need to realize is you're up now 100% on your account. So if you're up 100%, you have to make sure you secure your positions and you don't let them reverse. Because like I always say, the only thing that matters when we're trading is, are you profitable? If you're profitable and you want to make bigger profits, it isn't about becoming a better trader. It's simply about scaling your capital. So all we want to do is make sure that we can build a system that makes us profitable. So now let's get into the actual charts of this side. Now I've pulled up GBP AUD to a random moment in time where you can see prices even starting to react off of an order block. Now you guys can say, hey, price is reacting off of this level, it's still respecting this low, and it looks like it's going to play out. But what you have to understand is if you look at the macro structure, we still had this area over here that price could play into. Now, that doesn't mean that this area is invalid, but let's say that you're offered to buy some sneakers at $50, right? This is the $50 area. You're anticipating that these sneakers are gonna make their ways up to $80. So if you buy here and you sell here, then you're going to make $30 in profit. But now imagine that if you wait a little bit longer, you're gonna have the opportunity to buy those same exact sneakers at $30, meaning that if you take those sneakers from $30 and you sell them at $80, you've profited $50, meaning you've made more money, which is honestly the important part of this. So if you're more patient and you look at this entry, you're gonna see you have the potential of a 1 to 7 risk to reward. Now, if you take the early entry over here, you're gonna see that your risk to reward is only a 1 to 3.3. Now, if you watch as the charts play out, you're gonna see price ends up sweeping here, and that's not for a coincidence, because you guys have to understand there is billions upon billions of dollars being placed into these orders. So when we're actually looking to trade these orders, we have to make sure that we're on the right side of the chart. Meaning, you want to think logically. If I had billions of dollars, am I looking to get in at a worse price when there's a very high chance that price could give me a better entry? Or am I looking to wait for that better entry? Now you guys can see, if you were more patient on the setup, it's going to end up paying off, because you can see how perfectly price reacts off that order block, and then it starts to make its way upwards. Yeah, it starts to trend down for a little bit, but you guys can already see as I play it out on the weekly, take profits absolutely get smashed. And then guess what? After it gets smashed, price completely reverses. Now the importance of watching price reverse here is understanding that money does not make mistakes in the markets. The charts do not make mistakes. There is a reason why we end up taking out this high over here and then swinging all the way back down, because all the money that we wanted to make was sold over here. So imagine you're holding that shoe, that same shoe that we talked about, and now is valued at $100, and you can sell it. This was your target, and now you're thinking, the price of this shoe might go up to $200, and this is where psychologically you have already lost it. And if you start to think this way, you will never make it in trading, because if you see this, price absolutely smashes our initial target and then it reverses. And I'm going to show you because the markets print this over and over and over again. So if I go back to previous data, you guys will see here, I don't even have to point out anything here, but if you look left, price has this order block over here, and you can see this one gigantic wick shoot you all the way up, take out price, and then sell off. The more more left you guys look across any pair, you're gonna see this occurring all over the markets. So if you look, price was making its way on an uptrend, right? And you can even draw this little trend line over here, which I'm just gonna change the color to black. And then you guys will see, once price breaks out of it, it ends up sweeping the entire trend line. So you never wanna be the guy who's selling early, like on these wicks or something. You always want to make sure that you are able to stay patient and understand that your psychology has to stay in check when it comes to trading. So here I've brought up another pair, and I want you guys to understand why. I want you guys to take a look at exactly how the markets are playing around these levels. If I were to go on the daily here and I wanted to take an order based off of this zone down here, you can see price perfectly reacts off of it. Now, if I'm smart, I can also look to be refining this on a lower entry, right? So instead of taking the order just off of the daily, I could make my way down to the 4 hour and refine my order block as long as it makes sense, and then look to take that upwards. Because let's say I get in down here and I have a very big stop loss, because obviously I'm just showing you guys the higher time frames of things, but I would already be up 1 to 1.8 versus if I took this trade off of the daily zone, which is all the way up here, I would only be up 1 to 0.6 risk to reward. So you guys have to understand, psychology isn't just like a one-word meaning in Forex. To me, it is such a big realm. And the main pillars of it are staying patient, building a high stress tolerance, and building a sustainable approach. For example, a sustainable approach to me is something where you're not slaving yourself away on the charts. So that way you can understand that you have a personal life and you have a trading life. And you don't necessarily want to mix these two. I understand it's going to be hard in the beginning because you only want to get better. You always want to be sitting on the charts, and that's a normal feeling. But you can't live your life in the fact of where if you lose a trade, your personal life becomes a huge mess. You have to focus on these two things individually and understand that we're looking to better ourselves in whatever ways we can, not necessarily just in trading, because the more output you have, the more input it's going to feed into your trading account. Alright guys, now I want to show you how to piece everything together and create essentially one big trading model. So what I'm going to do is I'm going to hop on TradingView and go to the replay mode and show you guys exactly how you can trade this strategy using every single piece so you can perfect it for yourself and mimic the same results that I get. For example guys, here it's GBP JPY. And this was actually a trade that I ended up taking. So what I want you to realize right off the bat is if you go to the daily and you mark out this level over here, and I'm going to use my magnet tool just to make this easier and also turn on the extend right feature when it comes to my zone. I would mark up this level here and I would extend it towards the right side, and just to make it easier, I'm going to click extend right. And as we know, we keep these ones blue. So if I extend this to the right and I cross-reference this with my weekly time frame, I can see that it still shares the same bottom wick as the weekly. So I'm already understanding, hey, this daily zone is also in line with the weekly, making it the strongest zone that I could possibly get. Now, when price starts to reject, I want to identify what is the lowest order block that the refined price has been to. So if I look left on the 1 hour, right, I'm just going to go in replay mode. I'm going to show you guys this little trick. This is how you can refine and make it very easy. If I look left, I can see, okay, this is the hour 1 order block. So I'm just going to draw a line right there for my hour 1. And then I'm going to double click it, put text and put H1. Then I'm going to go to my hour 4. And my hour 4 order block is resting right here. So this is exactly how I refine my orders to make sure that I get the best entries possible. So now if I exit this mode, I can see, okay, missed the hour 4, missed the hour 1. Now it's on the daily. Now if I'm letting the daily play itself out and show me essentially what it's going to do, like I did here, I can see we have this huge rejection, price tries to break down, and then price goes back up towards the upside. So I could look to get in over here, which in my opinion is still an aggressive entry, but I also understand, hey, if I look, for example, on the 4 hour time frame, we were extremely bearish. And even if I go to the 1 hour, I can see, okay, we were extremely bearish. Price had, we can kind of draw some trend line liquidity over here. Price resisted a bit, broke out, and then retested and broke above. So to me, these are all little confluences that would help me get into this trade. And even if I see this, price pulls back and creates a higher high, now I can follow simple market structure, right? So think about it. If I'm noticing that price was moving like this, and then now we've broken towards the upside like we did over here, and now we're retesting kind of that trend line liquidity over here, and then we're going to break above and create a higher high, then I can already identify that we've shifted out of this downtrend and already moved into an uptrend. So at this point, if I'm looking to get into a small scaling position here, I could be looking for example, something like this, where I'm just simply following the structure of the market, where I'm putting my buys right there and I'm putting it over my previous low. So if you guys follow the structure here, let's just say high, low, lower low, lower high, higher low, higher high, higher low, higher high. So I get in on the higher high because that now confirms my higher low, and then I could just be looking to target the rest of this trend line liquidity. Now, obviously, this is not something that's been fully played out yet, but you guys can see even just current market did push up 400 pips, which would be a 1-to-1 on here. Now, this has nothing to do with actual like full-on refinery, but it's just showing you guys the basics of that strategy. So here's another perfect example that I had on the daily time frame for GBP USD. So you guys can see I had drawn out this zone essentially, which wasn't a zone on the daily, which is why that zone ended up getting ran through. But then what I did was I re-looked at the charts and I saw, hey, you know what? We did have this level over here where price touches into and rejects. Now, not only that, we did have this massive downtrending liquidity over here. And if I go to the 1 hour time frame, I'm gonna notice just how heavily price respected it. So if you guys look here, you're gonna notice price respects it very heavily. I've already seen that price has touched into a daily order block and then broken structure towards the upside. So at this point, what I'm looking for is the pullback and then a higher high. So if I'm simply following the market structure and base it off the higher time frames in the back of my head, I can get in on this higher high, tuck my stops under this previous low, and then I could just put my take profit at the end of the trend line liquidity. So as you guys can see, it would be all the way up here, and that trade gets absolutely smashed for a 1 to 4.5 risk to reward ratio. Now, think this is a coincidence? Okay, let's go check out another pair. So here I'm going to start out on the daily for Euro USD. And so here I can already see price is resting where? Well, if I'm looking here, price is already approaching this massive order block over here. And then I'm going to go to my 8 hour, my 4 hour, my 1 hour, and I'm going to wait for price to show me some sort of reaction out of this area. And what I want to make sure is that I'm finding the lowest time frame order block that price is playing off of. So if I'm looking over here, that is my 1 hour order block, and I look right and hey, you know what? Price is in that level. And I'm starting to see it reject, but also I can tell price might have pushed onto another time frame based on how heavily it pushed all the way up. So if I go back and I check my replay mode over here, I go to my minute 15, I'm going to see, hey, you know what? Okay, this was my minute 15 order block. I can obviously see the hour 1 was higher. So I'm going to go with the hour 1. The minute 30 has already been played into, and the minute 5 looks like it might be something that the charts have actually latched onto. So I'm going to draw a horizontal line right there. I'm going to exit out of replay mode, and I can see, hey, look, very clearly, price builds some liquidity over here, sweeps it, comes down, doesn't necessarily break our structure, but then sweeps it again and then breaks structure towards the downside. So to me, this, as long as we create some sort of clear break over here where I see price close under this, then I could be looking to enter a short position. Obviously, I could try to get in now, but I would obviously rather approach the markets with a late and right versus early and wrong mindset. So now I want to get into a strictly replay mode setup. So for example, here I'm on NZDCHF, and I'm just going to pick a random moment and try to, figure out what's going on here. If I go to my 1 hour time frame, I can see, hey, price is moving bearish, obviously, right? I can see this very clearly. Now I have this big supply zone over here, but the only thing that I don't like is that this candle did push us all the way down, meaning to me that there is a lot of money resting this order, so it could want to be treated as liquidity. But if I know that this wants to be treated as liquidity or have a very strong feeling, because obviously nothing is guaranteed on the charts, then I could be looking right above it for a smarter order block. So if I look at this level over here and try to see price sweep this out, now I have, this is my liquidity resting above my order. If you look over here, this is going to be a fair value gap right over here. And then you can see we had that liquidity right there. And if I'm patient and I wait for price to build up, I can see price actually respected this first zone, pulled back, and then ripped straight through our zone. Now, the beauty of this strategy is, I know some of you guys are going to be like, oh, it just failed. But guess what? If I need to wait for confirmation, right? Because I need to wait for my lower time frame to create that break of structure, then I don't receive any sort of confirmation. Because here, if I refine this order block to my minute 5 and I move right, then I can see nothing there has been held. Now, if I even go down to my minute 1, I can see that when we're in this zone, there's still no break of structure. We've just broken out of the zone, which completely invalidates it to me. So I'm going to keep playing this out and try to identify what zones I can take. So now, okay, I've seen this has been swept, this has been swept. Let's see if I can find some sort of order resting over here. If that's my real order block and I go back and I refine this down to the lowest time frame I possibly could, then let's see how this plays out. So here I'm on the minute 5 and I refine this down to this, and I'm looking right again, and I can see price touches in and then breaks structure over here. So now that price has broken structure, I could be looking to get in some shorts. And now when I get into my shorts, I'm going to be looking on the higher time frames and finding my targets. So I can already see there's a fair value gap over here, which I could potentially see price trade back into. And honestly, at this point, I would just want to move my stops to break even, because I still see we still have this type of liquidity here. Price never broke out of this. So this is a very aggressive counter trend trade. And I don't even know if this is going to hit. I still don't have the answers. Once I reach this fair value gap, considering that this fair value gap comes off of the push of this trend line, I'm going to want to make sure that I move my stops to break even. So if we just watch as this goes, okay, now I've entered that zone, I'd be moving my stops to break even. And then let's see how the rest of it plays out. Boom, you guys can see we're trading into that zone. We barely miss our break even right there. And then you guys can see price touches that trend line. So this trend line could be your take profit. And if we break out of it, we could even be looking to take another entry and trade all the way down to the bottom of this liquidity. So you guys can see we have a big wick right there. But if we get a solid candle closure under this trend line, I would be very open to getting in again. So here, what I want you guys to identify is what price is starting to do here is we had this push towards the upside, and now we're starting to create lower lows and lower highs, lower lows, lower highs. And now we've just broken under. So what I'd be looking for, because this is a high time frame and I have a higher time frame bias even behind this, I could now be looking to get in at the close under here because we've just broken this structure. And I can see that if price is truly moving bearish, we're going to be saved by this over here, right? So you can see we already broke under the trend line, and then we have that lower high right there. And then when it would be coming to my target, I'll just be looking to find the liquidity resting towards the bottom of this trend line. So if I let this play out, you guys can see price already literally sprints towards that area. So just within this one pair, I've been able to identify two amazing setups towards it. So I have this one, which would have been, let's just see real quick how many pips the stop loss was. So this was a 1 to 3.5, just trading it down to the trend line. And then this was another 1 to 2.35 risk to reward ratio. So just right there, you've smashed about 6 risk to reward. I'm going to show you guys one more example just to make this strategy even clearer for you guys. And literally trading is this simple. This is the same model that I use day in and day out to generate all of my profits. All right, so here I'm going to be showing you guys another example on AUD USD, and this is actually a trade that I ended up taking last week. So you guys can see on the daily we had this order block right here. Now what I really like is you have that order block, and then you have this fair value gap resting right above it. As we know, the order block levels are blue and our fair value gaps are green. And not only that, we have all this liquidity resting over here. So you guys can see here, we have all this money resting on the charts. Price sweeps through the liquidity first, breaks through the fair value gap, and then starts to reject towards the upside. So now I understand I'm reacting off of a daily order block. So I'm not necessarily looking to wait for the daily order block to break its structure. Now the first thing I want to do is identify, can we refine our order? So here I'm zooming into that order block and I'm seeing, hey, on the hour 1, it's over there. Now let's see how it looks on the hour 4 and the hour 8, because potentially I could refine it down to those time frames and catch a very nice entry. So now I'm back to where we were looking at, and you guys can see price touches on the hour 4 order block. Now, since it touches on the hour 4 order block, I want to be waiting for a structure break and either a retest or to be able to follow structure towards the upside. So the first thing I want to do is look and see that, hey, you know what? We did have some downside liquidity over here, and I can see we broke out of it, and it looks like we're retesting it and respecting it to go the opposite way. So here you guys can see price is now breaking towards the upside, where I have a high, a low, lower high, lower low, higher high. And so now I want to let markets generate a higher low and then look to take this towards the upside. So here I can see prices have stagnated over here, built some sort of demand over here, which this candle took to push towards the upside. All right, so here I can see that price has broken structure very clearly, and it's not playing off of any rejection order blocks, which is something that I really like. So now all I want to do is wait and see, is price going to give me some sort of entry over here? Or can I even go to my hour 1 and identify some sort of market structure being played? Because when I'm looking to enter strictly off of price action, I want it to be that break of that first zone, and I always want to find it on the hour 1. Price was trending downwards, and then we have a high, a higher low, higher high, higher low, and then obviously these start to break up even higher. So off of that first market structure break, you could see that this would have been an amazing entry position right here. If you just look to get in on the break right there, and then your target levels could literally be the top of this liquidity, or you could look to fill in the fair value gaps. But obviously when I have these trendline breaks, I like to take them to the top of the liquidity, so that way I don't have to deal with the entire pullback, like all this move, just to catch a further move towards the upside. I hope you guys learned something from this video. Stay tuned with the course, and I will see you guys in the next episode. Welcome to section 4 of the Pip and Dip Blueprint, and this is where we are starting to get advanced on the charts, and I hope you guys take some deep notes because this is going to be where you learn all the sauce to make the most amount of money. Stay tuned. Alright guys, in this episode we're going to be covering one of my favorite concepts. It's called real highs and real lows, and this is how we avoid fake outs and fake breaks of structures in the charts. So let's get right into it. So it's very simple for us to identify market structure as bullish or as bearish, right? This is not an issue for us anymore. But as we notice, it's not always that easy to identify. Sometimes you're going to see the markets go like this. And within our uptrend, you're going to see a lot of weird stuff going on. Or within our downtrend, you're going to see little uptrends and downtrends within there. Now, this drill is something that I like to use as confirmation when it comes to actually entering my trades. What I want to show you guys is the actual reality of trading. This is real highs and real lows. Nothing in this order is actually considered a real high or a real low until we break above our lowest point that price pulled back into or our highest point which price left us at. So for example, if price is moving like this and gives me my high right there, obviously it's pulling back now and it's doing this. This is not a downtrend until I break my low. So I have my low over here and I have my high resting over here. So nothing in this order is going to be considered an actual move until either my high or my low gets broken. So let's say my high gets broken at this point and then price starts to pull back now. In this moment, I'm going to identify my new low. And the way I'm going to do that is by pointing out the lowest area that price had reached. This level over here would now become my new low. And now this level over here where price peaked at would become my high. Now let's say price continues and does this. Now at this point, this becomes my new low and this becomes my new high. Now let's say price starts to do this and then it breaks structure towards the downside. So when price started to pull back down, it created this level here. And this was the highest point in which price pulled back into. So this is going to be my new high. And then I'm going to wait for one pullback candle and then I'm going to draw my new low. So at this point, if I want to identify my new low, I could be saying, okay, price could move like this. And at this point, nothing is going on to me that's significant until we get a candle closure below there. So once we have that, you can see that would become my new low and this would become my new high. Now let's talk about the scenario where price ends up wicking. Now I'm going to use this tool where I'm actually drawing in order to signify if it's a wick. And if I use this tool over here where it has the arrow, that means it's a candle closure. So let's say price is over here and we end up having some sort of candles form this way and then this way. And then price pushes us towards the downside like this, but we don't get a candle closure under there. At this moment, I'm not going to move my high because if we had a candle closure over here, right, if price closed down here, then I would be moving this down here. And once we pulled back, I would now have this over here as my new low and that would be my high. But since price didn't create that and it only wicked below, all I would simply do is push my low further. So you have to think as wicks as something that is going to push our real lows and our real highs. You always want to think of it as it's very hard to confirm an entry and it's very easy to invalidate an entry. So at this moment, I would push this down. Now let's say price comes back up and now it's closed below this low, but it never closed below that wick. At this point, it's still not a break of structure. It's still not a real low being printed. I need to see candle close below the lowest wick. So let's say price wicks us even further down. Again, now I'm gonna push this even lower. Now at this point, price can do this and then close below. And it's that moment where I'll move my high towards that lower area. And now my low would then be over here, right? That is a very brief intro to real highs and real lows. And now I want to show you guys something within the real highs and real lows. So as we know, this is how our actual market structure ends up looking. I want you guys to understand that this isn't just here for no reason. This is our trading range. And a trading range in the markets is simply designed to throw us off because the markets understand that when we lose, somebody else is out there making money. And this is why so many traders fail, because they fail to identify things like this. They think, okay, we pulled back here and then we broke towards the downside. So now I'm going to take a sell position. And then they're going to get stopped out on their sell. And then they're going to be looking, okay, now we broke towards the upside. So I'm going to take a buy position over here. And then guess what? They end up getting stopped on their buys. So it starts to manipulate them and they get wicked out both ways. That's why trading isn't necessarily as simple as going buy or sell. You still have to have the right values because you can put a buy trade and a sell trade at the same exact time on the same pair. And you could still lose both of them if you don't have the right values. So at this point, I'm going to show you guys one more drill with this where I'm drawing it out where you guys can see price is doing this. And then now I'm going to draw, okay, my low at this point is the lowest area we were at and my high is going to be at the highest area we were at, which is over here. So now if price does this and then pulls up, comes back down, and pulls up to here, and then price wicks us above, all I'm gonna do is move this. And then the second that price ends up coming back and breaking above is when I'm gonna move my low and then put that over there. So now everything in between is a trading range, and I have to be able to identify, okay, my trading range is now from this point on. Every single time we break above or below, we're able to move our trading range. So let's say we do this, okay, now we break above. Now I understand my trading range is only going to be anything printed on from here. Now I always want to move my lows and my highs to the lowest and highest points that are created within my trading range. So if my trading range ends up forming like this, and then I break down, well, the highest point in my trading range was over here. That will become my high, and then my low will become over here. And my new trading range will form from this level on. And ignore obviously the stuff to the left. I know it could be a little confusing, but it's just how it is. So now if price pulls back up and comes to here and then breaks down, the highest point within my trading range was this level here. So this will become my new high. And that is the significance of using the trading range. So now I'm actually going to show you guys this on real candles. Now I love doing this drill on the minute 5 because you see the minute 5 wick us out and do all this fake stuff all the time. So it's really precise when it comes to actually perfecting this. And then I'm going to show you guys how we actually piece this towards our orders. So here, for example, I'm just going to identify my real high at this level and my real low over here. So everything from this moment on is my trading range. And now I can see price does not close, it is wicking above, so I'm going to move this higher and I'm just going to wait. So price has wicked above and then we didn't close above the highest wick, so I'm still just moving this. Now keep in mind, if this is my trading range, I'm going to use this at a certain point. So now I can see, okay, price has now broken above here. And what is the deepest area in my trading range that price pulled back into? It was this level over here. So now that's my low. This is going to be my high once we print that next bearish candle. And I have my low over here, and then my new trading range starts from this moment on. So at this point, all I'm doing for is waiting for one of these sides to have a candle closure below or above it. And now I'm watching as price is doing its thing. Boom, boom, boom. And now price has broken towards the downside, and all I wait for is one pullback candle, so that way I don't keep dragging it all along. But now I have that one pullback candle right here. The deepest area that my highs pulled into was this level over here, and now my new trading range is going to start from this moment on. Now I'm going to let the candlesticks play. Boom. Over here, you guys can see we wicked it further up, so my high was pushed to here, and then we broke above, and now we closed right there. So the deepest area that price pulled back into, as you guys can see, price goes up and then pulls back here. This is the deepest area, making this my new low. Now I can do this drill all day long. And this is something that every single trader I see struggles with and ends up losing a lot of trades for this. So feel free to watch this video as many times as you guys need, or ask me questions when we do our weekly calls and stuff. So here you guys can see price continues to move, boom, boom. And now we break below. And since this was our high, my trading range starts at this point over here. Price pulled back into there. And so that would become my new high, and my new low is going to be over here. And my new trading range is going to start from this candle on. I'm going to show you guys one more example right here. And then from this moment on, I'm going to be showing you how we actually use this for our confirmations when it comes to entries to make sure that we don't end up getting faked out of a trade. So you guys can see here, we break below, and all I'm waiting for is one pullback candle. Boom, right there. You guys can see that. The deepest area we pulled back into is that level. And then same thing, you guys can see we had one candle there. That would have been my new trading range. That would be my new high now because we broke below, and then that would be my new low. And the second we have one pullback candle is where I would then start my new trading range. So boom. Now I want to show you guys how we use this for actual entries. So I'm going to pull up a random pair and then show you guys from there. All right, guys, so here I'm on Euro USD, and this is a perfect example of how you would use your real lows and your real highs. So here I can see this was my low, and then it finally got broken at this moment here. You guys can see it pushed over there, and then we broke towards the downside. So now my high was resting at the deepest area we pulled back into, which is over here, right? So now in order for me to see a bullish break of structure, I need to see price break above this level. And this is going to be very key when I'm actually piecing it together with my order blocks, because I need a break of structure towards the upside to get me out of this massive downtrend in order to take a bullish order. So you guys can see over here, we have this break of structure finally right there. And then now I'm focused on my order block resting over here. Now the important part, as we've been going over this whole time, is finding that refined order block. So here I can see, okay, we touched on the minute 30. Did we break structure? No, not yet. Did we touch on the minute 15? Yes, we touched the minute 15 order block. Okay, great. Did that one break structure? Yes, because if I follow over here, I can see I had my low over here, and I'm going to show you guys this in like candle by candle time so you guys can really grasp this concept. So here I have this candle. I'm going to wait for one pullback candle right there. If this is my low, then my high is resting right over here. right? And everything inside is a trading range. And then you guys can see price, it pushes above and then it breaks below. So now I'm just gonna wait for one opposite candle to print, and then that'll be my new low. So now I have this opposite candle printed, and now my trading range is going to start from this level on. So I'm gonna be looking from here on, and at this moment, I can see, okay, price, has it touched my minute 15 order block? Yes, it has. I also just want to cross-reference, has it touched my minute 5? Because this is very important. My minute 5 order block is going to be resting at this level over here. So I can also see, okay, price did touch on my minute 5. So now the important thing is identifying where price touched, like the lowest time frame, and then finding that break of structure using our real lows and our real highs to confirm that entry. Now I can see we've touched on the minute 5, and all I'm going to do is be patient. Price now breaks even further down, and I can see the deepest area we pulled into was this level here. So this becomes my high. I'm going to wait for one opposite candle to be printed, and then I'm going to point out my low. So now I have an opposite candle that was printed. That is my low, and now my new trading range is going to start from this level on. Now, one thing I also want to cross-reference is, did we touch any further lower on the time frames? Now, honestly, I think the minute 5 is like the perfect one for confluence entries, but I can see the minute 4 order block is resting over here, and let's just start to mark these up. So as we said, this was the 5, this was the minute 4. I'm going to go now to my minute 3 and see how that one looks, and then just do the same thing all the way down to my minute 1. So my minute 3 is in line with my minute 5, meaning that if it came down to it, I would use my minute 5. Then I have my minute 2 order, which is going to be resting all the way down at this level here. And then last but not least, I'm going to check the minute 1 order and see just how that one looks. So now I can see that my minute 1 order is the same as my minute 2. So if it came down to it, I would be using my minute 1. But now all I have to do is come back to where price is and identify, okay, now I'm playing off the minute 4. So let's look at our real lows and real highs on our minute 4. So my low on my minute 4 is here and my high is the same thing, meaning that in order for me to get a break of structure, I would need to see price break above this level here. So I'm waiting for a break of structure as a bullish character over here. At that point, I would be seeing a bullish order to take. So here you guys can see price starts to move, ends up pulling back down, and then it breaks structure. So at this point, we have two options. We can, one, take the order on the break of structure for a more early entry, and we still always want to be sharing that same stop loss, or two, we can be looking to get in on these refined entries like that minute 4 order block, and same thing, we're going to be sharing that same stop loss as down there. So you guys can see price starts to do its thing. And when it comes to choosing our targets, keep in mind we found our orders on the 1 hour time frame. So now what can I do? I can find that same order on the 1 hour time frame. Now, even if I think as price action is moving, if we're moving in a downtrend, as you guys can see, this is all downtrend structure here. This is like that last lower leg, and then we break structure towards the upside. We pull down, and then now we're kind of ranging over here, and then we break towards the upside again. I'm pointing out this level over here just to make that even clearer for you guys. So if I'm really moving bullish and price pulls back down, then it's going to be moving even further up. So all I could be focused on here is identifying that same liquidity resting towards the upside. So let's see. So I would have two possible entries here. One that would give me a 1.8, 1 to 1.8 risk to reward ratio, and one that would give me a 1 to 4 risk to reward ratio. So now all I want to do is identify, okay, what actually happens on this order? Do we get that other tap, or do we play off of the early entry? And one good thing that you guys could do in order to manage risk on these is literally split the risk amongst both trades, or just make sure that when you're approaching them, you have a proper risk management solution between them. So you guys can see it like kind of wicks around at that take profit level. I'm just going to go on a higher time frame because I really want to see what the outcome of this trade ends up being. As you can see, price is starting to pull back down, and then boom, take profit gets smashed and price continues even further up, showing us even more confirmation that it really is moving in an uptrend. So now I'm going to be showing you guys one last example on this, and then we're going to get into our next video. So here I'm on NZD-CHF on the 4-hour time frame, and I'm just going to quickly mark up this order block resting up here, and then I'm going to use my bearish zone / order block right there. And then all I want to do now is identify what's the lowest time frame that price is pushing off of. So here you guys can see this does look like it was a news release candle, but I still want to point out exactly how we would play this. So here I can see that the minute 5 order block is going to be this candle over here. And when something is this big, I just want to quickly identify all of my zones. So my minute 4 is going to be resting the same as the minute 5. My minute 3 order block is going to be this level over here. Because remember our rules, if it's a bullish order on a bearish candle, I'm going to be going for body to wick. And if it's a bearish order on a bearish candle, then I'm going to be going wick to wick. So that's why that 3 minute is different than those two. Now here I look at my minute 2 order, and it's the same as the 5, the 4, and now the 2. And then my minute 1 order is very slightly different, but it is different. So you guys can see here, this is a different order at this level here.
minute 1, and then all I want to do is get back to where we were. So I'm just going to quickly go back in replay mode, let this kind of play out, and then bring us back to where our price was. So we were here. Now all I want to identify is what is the lowest time frame that we tapped into. And so let's see. So it does look like we did tap into the minute 1 order right there, and this is a news order, and so this is very important when it comes to identifying. Obviously we had our real low and our real high, and now I'm waiting for a candle closure above one of these to happen in order for me to take an order. But as I can see here, we wicked above and then we didn't get a candle closure, so I can't call a break of structure right there, and all I can do at this point is be patient. Now this order might play out without me, but that's something that I have to be comfortable with, because I'm not looking to bend my rules, because if I bend my rules here, it's like, for example, imagine you ran a red light to save time in traffic. You might save time today, but the next time you run that red light, you might get hit by another car. So the idea is we might make money on this setup here if we just get in off that wick and then the break towards the downside. But the next time this happens, it could absolutely blow our account or just even make us lose a trade that we shouldn't have lost. So I'm going to go to a higher time frame here and let this play out. It honestly does look like this order just kind of moved away without us, but I'm totally fine with that. And now I'm just going to bring up even one last example where, hopefully we can see the order play out with us. I'm just going to pick a random pair and then we'll move from there. So perfect. Right here, like literally right to the moment I opened at, AUD CAD has this bullish order block right here. You guys can see that. And now the way that I want to identify this order is obviously I'm going to hop in the replay mode, find out the lowest time frame order block that we played onto. So if I look left, right, I'm going to start drawing out all my order blocks. So I have this one over here on the minute 5, and I'm just going to bring this bar back all the way to here. So I have this order resting over here on the minute 5. I have the minute 15 order resting over here. I have the minute 30 order resting over here. So my minute 4 is going to be right here. My minute 3 order is going to be resting right here. And this is essentially the way that I identify what the algorithm is playing on in the markets, right? So my minute 4 is the same thing as my minute 2, meaning that I would use the minute 4 if it came down to that. And then also I have my minute 1 resting all the way down here. So now I'm just waiting to see what is the lowest order block that price actually taps into and plays off of. So right off the bat, I want to point out, guys, we have this beautiful fair value gap, right? You guys can see over here. We have this liquidity all building up over here. And then now we have that liquidity get swept, the fair value get ran through, and price touching into our zone. So right off the bat, I can see already price isn't necessarily respecting or coming down to any of these entries. It looks like it's playing off the hour 1. But what I can notice right away is, hey, price actually does break on the hour 1. So since price breaks structure on the hour 1, right, you guys can see right there, because we obviously had this high and then it was pushed higher and it was candle closed over there. Now what I can do is try to identify some sort of pullback entry over here, or if I really wanted to hop into this trade, I could get in at this level here for a bigger trade, yes, but it's still a very high probability trade. And then I could just be targeting the liquidity resting all the way up here for a 1 to 2 risk to reward ratio, while I could still also be waiting for some sort of order down here. So you could take an order over here, which I see nothing wrong with, but you also have to identify exactly what's going on in the market. So the same way that I identified my fair value gaps on this side is the same way that I want to point out this fair value gap over here. And then I see that we have liquidity resting right above that fair value gap. And then I have another fair value gap right here. So the same way that we would look to trade this for buys is the same way that somebody else could be looking to trade this for sells. So when we're actually filling these in, like for example, once we're at this level here, I would need to be at stops that break even. It's already a trade where I'm kind of chasing it a little bit more because I don't have that refined entry down here. I'm getting it on a higher time frame entry. And then also I'm still like playing this in fashion of there's 2 fair value gaps. There is resting order blocks up there. So I don't want to be caught in an ugly mess essentially. So here you guys can see this target would be hit. And at that point, I think that it would be very smart to move your stops to break even because you've just swept this liquidity right above this fair value gap. And then as you guys can see, price would then be moving, push up a little bit, and then actually you would be tapped out break even. And let's just see what the end result. And yeah, right there, you guys could see you would then hit stop loss. So I've given you guys an example where this confirmation has given us a straight winner, where this confirmation has saved us from entering a trade at all, and also where this confirmation has saved us from taking a loss. So I hope you guys enjoyed this episode, and I will see you guys in the next one. Alright guys, so in this episode, we're going to be covering how to refine our orders. Now, the importance of refining our orders is to make sure that we can maximize our risk to reward ratio. In other words, make sure that we risk the littlest amount possible and capture the largest amounts we can possibly gain. Let's get right into this. Alright, so here I'm going to pull up just AUDJPY, and I'm going to be bringing up some examples of order blocks. So obviously we know that when it comes to trading, we like to trade these big impulses on the markets, right? So areas where we're going to find order blocks would essentially be here, and once we create that new high, it would be here, so on and so forth. So every single time we take an order block, we have the opportunity to get in at the top of the order block. If this were our example, we would have a 1-to-4 risk to reward ratio. Now, obviously, as we know, if we were to get in at the top, we're going to face a little bit of drawdown, and then price could then potentially go in our direction. Now, what I want to teach you guys in this episode is how we can avoid catching this drawdown and essentially catch this trade down here. So instead of us catching on this order a 1-to-4 risk to reward ratio, we're going to be catching a 1-to-9.75, because now we're going to be in this pullback phase. This is the phase that I'm talking about. So when I'm actually looking to my lower time frames, it's going to be looking as if we're on a downtrend. But on the bigger picture, we know that we're still in this uptrend over here, right? Because this is what we have. We have a low, a high, a higher low, and a higher high. So the idea is when we're actually in this pullback phase, it's going to look like this. And what we want to do is identify a break of structure within that zone. So once we're actually in this zone, I'm going to start looking towards my order blocks. And essentially what I'm going to do is find out what candlestick does this play off of. So this over here, let's say it pulls back down and I notice, okay, this is touching. If I were to find my order block on my lowest time frame, would be the minute 5. So then I would then scroll down to my minute 5 time frame over here, and I would be looking at, okay, if this is how my minute 5 time frame looks, I've now just broken structure, and now I have my order resting over here on my minute 5 time frame, leaving me with an entry over here, and then I could look to take this further up, which would essentially be this model over here. This over here would be your M5, right? Minute 5 time frame. And this over here would be like your hour 1 or something. So you're essentially focused on this pullback phase and identifying the break of structure in this pullback phase to catch less drawdown in your orders and maximize your risk to reward. So now I want to show you guys how this actually looks on the chart. All right, so here I'm on AUDJPY, and I can see, let's just point out this level over here. So if I look over here, I can see, all right, price has an order block resting right here. Now, there's a couple reasons why I like this order block. First, it's just beautiful right here. You guys can see that's a perfect order block candle. Second, when it left this huge fair value gap in the markets. So as you guys know, we just draw up our FVG right there. And yes, it was immediately traded into, but it was still a nice fair value gap. Now, another thing that I see is we have all this liquidity resting over here and resting right over here as well. So we're building up all of these levels. Now, like I said, I am on the hour 1 time frame right now. And I bet you if I were to even go to my hour 4 time frame, this order block is going to look amazing as well. Right? So let's say that I were to take this off of the hour 1 order. I would then be looking at my entry being over here. Now, obviously, when it comes to my take profits, I want to identify where is the liquidity. So here I can see that we had some downtrending liquidity and that we have a fair value gap. So whenever this happens, I want to make sure that once we trade into this fair value gap, I put my stop loss to break even. Now, one very clean target for here would be targeting essentially the trend line touch. And this right here, just off of the hour, would leave me with a 1-to-5 risk to reward ratio, which is not bad. That's actually a beautiful trade. But what I want to make sure is I want to identify what's the lowest time frame that this price actually pulls back into. So if I draw a horizontal line over here and I go into replay mode to see what price is showing me in this area, just so it doesn't move around, that's the only reason why I would pull up the replay mode right there, is I can see, okay, I have a minute 5 order block resting down here. So this is how I like to do it. I like to show my lower time frame order blocks by putting a horizontal array, putting the alignment towards the right, just so it stays towards the end, and then just drawing out all my order blocks on my lower time frame. I like that this one is the 5 and the 15 on the same moment, because I know a lot of you guys are going to ask that question. What happens if you have the same exact order block resting across 2 time frames? So in this scenario, I would go with the one that is the higher time frame. So right now I'd be focused on the minute 15 right there, but then I would also go to like my 4 minute, my 3 minute, my 2 minute, and my 1 minute. So this would be my minute 4 order block. I'll then go down to my minute 3, which would be resting right over here. And keep in mind, guys, I'm just looking for the candle with the lowest wick. And then I'll be going to my minute 2 over here, which is the same thing as my minute 3. So keep in mind, if it does play off that one, I'm going to be going for the minute 3. I still want to mark them up just so later on I don't get confused and be like, oh wait, what was my minute 2? And I can see here it's also in line with the minute 1. So now when I'm actually coming to the charts, what I want to do is identify the lowest time frame that we were on before price actually broke structure. So if I come back into here and I bring this back to this level here, I can see 2 things. I can see, okay, price pulled all the way down to my minute 5. But I can see that price gave me a rejection off of the minute 4 order block. So the first thing I need to do is look at how did the minute 4 order block play out. So we had this level here, and you guys can see price obviously touches that horizontal ray, and then it pushes upwards. And when it pushes upwards, it actually breaks structure over here. So what I can do at this moment is set my limit order to this level. And what I want to make sure is not to just leave it at this order block, because at this point I've weakened my order. Because keep in mind, I had the 4 hour, I had the 1 hour. I even bet you if I went to the daily, the same order was going to be valid for me. So what I want to do is set it on the minute 4 entry, as we see over here, but then share the same stop loss as the daily and the 1 hour. So that way my order is as valid as possible. So if I do that, I can see, okay, price obviously runs into some profits and then it comes back down, puts me in drawdown. But since I have a valid order, you guys can still see it's being respected. And now it's playing off the minute 5 and the minute 15, but I already had my confirmation because it touched into the minute 4 order block and then it broke structure towards the upside very clearly right there. So now I want to follow through on my higher time frames and identify, okay, what can we see here? So right here, you guys can see I have a big fair value gap on the hour 4. Okay, so one thing I want to make sure is, since I have a fair value gap on the hour 4 and I'm still under this trend line over here, once we touch that fair value gap, I need my stops to at least be set to break even. And my perfect target in this level is going to be once price actually touches that trend line. So if you guys watch as price plays out, obviously since I'm in replay mode, it already showed you guys this 4 hour candle. And then you guys can see price starts to pull back a little, touches in there. At this point, it'd be stops to break even. And then you guys can see price pulls back a little bit and then gives us almost a trend line touch, and right there touches. So at this moment, I would close out this trade. Now I understand that I was in more profits here, but like I said, my perfect exit is going to be at the trend line touch. So I can see here, this is a perfect exit. If I wanted to be even more conservative, I could have just traded into this fair value gap and taken my profits there. Now this doesn't mean that price isn't going to break out of here, because look here, look at what we have here. Now price is starting to squeeze its way through. So if I get a candle closure above here, I could even look to take a trade to push me further up. But at this moment, I remember I had an 11 pip stop loss, right? So you guys can see that was my initial stop loss, and I've just secured a 1 to 9 risk to reward. And that's with the refined order versus what we had seen earlier, where we had a 1 to 5 risk to reward ratio. So now if I let this play out, I can see price breaks above and closes right here. Now, the only reason why I wouldn't see this as a valid buy is because we didn't have a candle closure above this wick. If we would have closed just that little, like 2-3 pips more, this would have been perfect. But right now it looks like price is still trying to fake us out, and I need some sort of clearer picture before getting into something. So here I can see price clearly closes above this wick, and it even respected these levels behind it. So I'd get in at this moment here if I wanted to take it further up. I tuck my stops right under that previous low, and now I could be targeting the rest of the trend line at the top of this liquidity, which would just be a smaller order for a 1 to 2.5 risk to reward ratio. But keep in mind, I haven't even refined anything right there. That is just strictly hour 4 price action. So you guys can see price starts to move up, it's respecting our trend line, it's respecting it, and then boom. Just like that, we found 2 orders, one where we completely refined and another one where we just followed the pattern after securing our profits and we're able to generate even more money. So I'm going to go on to another random pair and just show you guys another example of this. All right, so here I'm on USDCHF, and the first thing I do is obviously identify this order block on the daily time frame, right? So this is a bearish order block. I'm going to make it red. And then what I want to do is, when price is actually in this zone, I want to see what refined order block can I play off of. So if I look over here, I'm going to start to search. Okay, this is my hour 1 order block. It's going to be resting over here. So I'm going to put a horizontal ray right there. Then I'm just going to type H1. Then I'm going to go to my minute 15 and do the same exact process all the way down to my minute 1. So the easiest way to do this, guys, is just hop on replay mode, bring it back to that level, and then you'll be able to see it through there. All right, so here I'm on my minute 15 and I can see, okay, my order block on this one is resting right over here. And I'm gonna make these candles black. I was actually shooting a video that needed them to be gray for my student, but yeah, it was just way too hard to read right now. But you guys can see right here, minute 15 right there. Let's go to the minute 5. And you know, I can even go back to replay mode even further because now I have like a more precise look on it. So here I can find my minute 5 time frame, hit M5, and boom, save that. So now I have my hour 1 order block, which actually, yeah, is right here because that's a bearish candle. My minute 30 I didn't draw up, but I will now. And so now I have all of these order blocks resting right here. So I'm gonna go back to the daily and bring us back to where we were, which was the touch inside of this order block. So you guys can see right off the bat, fair value gaps, liquidity towards the upside being formed, liquidity towards the downside that had been broken. You know, all these things I want you guys to take note. So we were over here. And now if I go to my 1 hour, I'm just going to identify what's the lowest time frame order block that we play off of before we break structure. So now we're on the 1 hour time frame. So if I'm seeing this live markets, all I'm going to do is put this over here. And then from this moment, I'm going to set an alert on this. So if it breaks it, I know. And I'm also going to set an alert right here so I know which one it touches. I'm going to watch. Okay, now I can already see. Did we break when we touched the minute 15? No. And then we ran straight to the minute 30. So now that I'm on the minute 30, I need to see price break structure. So if this is my lower low, my higher low, higher high, higher low, higher high. So I would need price to break under here. And you guys can see we're getting wicks and boom. Now I get a candle closure below this. You guys can see higher low, higher high, lower low. So now what I want to do is essentially set my order off of this, but I still want to share the same stop loss as that daily order because it makes it that much more valid. Now, since I'm sharing that same stop loss as the daily order, instead of having to target something over here, right? If it's the minute 30, all I can really do is try to target some liquidity resting over here, you know, which isn't even that nice. Even if I were to take it down to this fair value gap, that's only a 1 to 1.3. But now since I'm trading off of the daily, I have a much higher strength order. So I can start to identify, okay, what do we have here? Well, we have this trend line over here, which price is heavily respecting. The most I want to take this order down to is this trend line. Now keep in mind, we have a lot of resting liquidity here. So I'm going to use that towards my advantage and keep that within my order. But if I were to just take this order at the top of the daily, this is only a 1 to 1.3 versus since I've waited for that break of structure and you guys can see we end up tapping in right here, obviously because the order is so small. Let's see if this order holds or if we're going to reach more drawdown or potentially even hit stop loss, right? So as I let this play out, you guys can see price actually sprints straight down and then even smacks our take profit. Well, I'm waiting for the trend line touch right there and you guys can see, boom, right there. We smacked that trend line right there. And now I have price has just smashed an absolutely sick 1 to 3 risk to reward ratio, all because I was more patient and decided to refine this order. Now, if I go on the daily, as you guys know, if price ends up breaking out of here, oh, well, I can already see it did there. I could look to take an order, but I would have to tuck it above that previous high right there. Since this is a daily trend line, I would be looking at it like that. And then I would be looking at the liquidity over here. So let's just see how this would have played out. You can see price kind of retesting over there. And then it ends up pulling up again, just to drop again. And it looks like price is moving bearish. Honestly, don't like how this is necessarily moving, but you guys can see once again, the strategy plays out. And this is why I absolutely love this strategy, because if you stick to the rules and you stay patient, the win rate is honestly unmatched. I've never seen anything win this much in the markets. I hope you guys enjoyed this episode. I hope you guys took a lot of notes. Keep in mind, it is absolutely normal to rewatch these episodes, go back and piece things together again. I'll see you guys in the next episode. Alright guys, in today's video, I'm going to be teaching one of the most important concepts to my trading strategy, which is the Asian lows and Asian highs. This right here is one of the holy grails, in my opinion, of trading. And if you follow this, it works as one of the best confluences for your trades. So let's get right into the chart. As you guys can see here, we have GBP USD. Now, the first thing you guys have to do on your chart is click this indicators tab right here. And I want you to search Asian range by Nico 948D. You're going to see it right there, right there. You're just going to click on it. It's very easy to add. You're going to go to settings and click show Asian range on 1 hour chart. You don't need to mess with any of the times that already automatically adjust them for you and everything. So you're good there. The significance of this indicator is it shows you the lows and the highs of the session. Now, why is that important? If you think about it, every single bank is moving price during these sessions. So if this is the highest point that price wanted to reach during the session, and this is the lowest point, that is not a coincidence. That means that the banks decided they do not want price to move any further than these two levels. So there's going to be a lot of money resting in those areas if you think about it, right? So when you actually step on the chart, there's something that you're going to realize, which is this is going to be price in its session. And this area here is going to represent Asian session for us. And what you're going to notice is when price actually exits Asian session, price is going to usually do one of these few things. It's either going to retest that high and respect it, and that just shows you how strong that this order block would be, or it's going to go back to that high, break it, and most likely come down to sweep the rest of the liquidity at the bottom, or you're going to see price come down, sweep the lows, and then come to target the high, or same thing, price come down, respect the lows, and then come to take out the high. So this is a very important thing when it comes to trading. I swear to God, guys, this alone has made me probably the most money, especially when I was a beginner, and is one of my favorite confluences. Like literally one of my first things I ever learned, and till this day, it's still a part of my strategy. So I'm gonna show you guys exactly how you would piece this together, right? So first thing I wanna do is just show you historically how this really plays out. So you guys can see over here, you have the low gets swept and then price, or the high got swept first and then price takes out the low. Over here, price takes out the low, then makes its way to the high. Over here, price takes out the low, doesn't take out the high. So it's not a guaranteed thing every single time. What you're gonna notice is that the majority of the time it does play out this way. Here, price sweeps out the high, then comes to take out the low. Here, price just shoots straight up. That is okay. Here, price confirms the low, retests it, doesn't break it, then gives us a super quick push towards the upside. So if you guys just look on literally any pair across your charts, you're gonna notice the same exact thing. This always plays exactly how it does. Here you guys can see price sweeps the lows over the next day, starts to trickle back up and sweeps the previous highs of here, here, and here. Now, it's not always just, it has to sweep it today. A lot of the times, especially when I see price miss sweeping one side for 2 days in a row, you're gonna notice that the day that finally one of them gets broken to the upside, it's going to sweep very hard. So if you guys look here, right here, we confirm this high and we continue down. Here, we never sweep this high. Here, we never sweep this high. So here we had 3 days in a row where there was no highs being swept. Then all of a sudden we sweep the high. You guys see it kind of tries to pull back down, just retests essentially. And then the next day we give a huge push towards the upside and sweep essentially 3 days worth of data right there. So I want you guys to understand there's different ways in which we can use this to our advantage. Now, it's not necessarily I'm going to see one side get broken and be like, okay, now I have to sell. We have to use this in alignment with other things, but I just wanted to start off by showing you guys the power of this. So for example, here I'm on GBP USD, right? And I'm on the hour time frame. And you guys can see right here, price is resting over here. You can see price in the last Asian session broke under, then broke above. And right now I see price over here where it's ranging in Tokyo session. And I see that I have an order block right here. And then what else do I have? Try to point it out before I even say it. So over here, I have a fair value gap, which has been filled into, but I still value it. And then over here, I have my liquidity. So here I have 3 things in alignment, right? So now if I have all of these, and then I get these highs of Asian session being broken first, it's gonna give me a much more solid bias that price is gonna wanna sell here. So if you watch how this plays out, price runs up to Asian highs, right? So at this point, what I wanna do is make my way down my other time frames. But if I just enter right here, literally based off of this, you can already see, I mean, that's still a pretty tight stop loss. That's 4.4 pips. And if I literally just target the lows of Asia session, that's a 1-to-7 risk to reward ratio. And this is without even refining my order. So here I'm just gonna let this play out. You guys can see it goes very deep in there and then makes its way down and literally sprints all the way there. Now, another amazing target that we could have seen here, guys, right? Let's just see this. So we had this resting liquidity over here and you saw price broke out of it. So this pullback up, I would have been comfortable looking to target this entire low, but honestly, I would be going for just right here where all 3 of these wicks match. That's a 1 to 14.3, and you guys can see the next candle absolutely rips it. But let's say I didn't get that. I mean, once we finally broke back under this level, I would have been totally confident to just enter right there and take this order right here. So right there within that, we already see 2 orders. Keep in mind, guys, we haven't even refined this order to take a better entry. So if you guys look over here, you can see price comes in, and what we need to do first is mark up the lower time frame order block. So if I pull back over here, I'm just gonna bring this one back to the minute 5, and then I'm gonna refine anything that I see that's smaller. So here's the minute 4, and I can see that is the same exact one. Here's the minute 3, and the minute 3, I mean, can't really tell if that's a bullish or bearish candle. It looks bullish, so I'm gonna go here and put 3. Here's the minute 2, which is gonna be right here, and then here's the minute 1, which is the same thing as the minute 3. So when we actually get back to where price was, I'm just gonna let this play out real quick. I wanna show you guys how we could have refined our orders if we would have been able to catch some sort of entry right here, right? So if I wanted to refine this order, I can see that it did play off that minute 3, minute 1. So what I have to do from this point is identify my real lows and my real highs. And here I can see, okay, price pulls down, pulls back up, doesn't give me a candle closure up there. So the real structure that I need to see it break is gonna be, let's see. So here we broke structure towards the downside, pulled back up. Now I need to see a break above there. So this is the deepest area we pulled. So now I have to see price break under here. Now, all I did right there was use my real lows and real highs drill. So once price ends up breaking this level here, I could have gotten in right away, like at this exact moment here. or I could be trying to wait for this pullback here. Now, one reason why I could see it not pulling back is because, guys, you do have to remember we did have this trend line that we just broke under, so it's very unlikely that price is going to want to retest all the way back up. But if it did, I mean, it could have left us with a great entry. But regardless, guys, we found 3 different entries right there, which would have amounted us to almost plus 20 RR total across those 3 trades. That right there is amazing. Now I'm going to show you guys another example of this. So here's an example where you guys can see price confirming Asian lows, right? So here you have the lows of Asian session, and you have price swept the highs, came all the way up, and then price came back down and is retesting the lows of Asians. So what I can do here is try to identify some sort of order block in this area, and then try to find out how we can play off of there. So here the minute 15, it doesn't touch. The minute 30, it doesn't touch. It barely misses on the minute 30. But on the hourly, yeah, I think it still barely misses on the hour. So that order right there, honestly, it wouldn't have played out on. But you guys can see just how nicely it respected those Asia lows and then, you know, started to push back up. Let's just see if price actually ever comes back down to retest that level, or if it just continues up. I mean, at this point, it's so late in the day, I wouldn't even want to enter because, guys, I don't like taking trades like outside of each other's session, you know? So let's move on to another pair just so I can show you guys another example. All right, guys, so here on OddCAD is an example that I really like. Here you can see price breaks towards the downside and then immediately breaks towards the upside in Tokyo session, right? So here we have this nice break towards the upside, leaving us with this order block resting right here. Now, what I like about this is we are still early in the session. So what I want to see is price on this pair show me some sort of confluence that we're going to be pushing towards the upside. So if I'm trying to find my refine order block, all I have to do is go on my lower time frames and start marking them out. So here's the minute 5, right? Here's the minute 15, which is almost identical. And then I can just keep doing this along to find my exact order block. So the minute 15 and the minute 30 are pretty much, they're not exactly the same. They are actually 2 different things, but they're very close. And even if they're very close, you guys want to make sure you want to find the exact one that is playing off of. But here I'm going to let this play out a little bit. And you guys can see price is already starting to stagger very heavily in this area. And then you guys can see price holds the bottom of Asia session right here and then gives us this massive push towards the upside. So one way you can try to use order blocks is in this exact scenario where you see we're resting on the higher time frame in an order block, and then you see Asian session leave a lot of support or wicks towards one side, showing you that there's a lot of strength in this area. And then you want to wait for price to essentially come back in and retest it and break structure. So here you can see price pulls back in and then breaks structure again, and then it comes up to sweep the highs. So if I were looking to take this order, I could have gotten in down here off the retest of this level once we exited, and then we had this big candle confirmation right here and just closed under here. Now what I mean by big candle confirmation is price comes down to retest the Asian lows once we exit the session, sweeps all this liquidity resting over here, then gives us this big push and leaves an imbalance in the market. Now another way that I could try to take this is by taking a limit order at this level over here. At that point, I could do that. And all I'm trying to do with this is find out how I can catch this move to fill in some sort of liquidity. So here I can see I have this imbalance resting in the market over here, this fair value gap, and I could just be simply looking to trade into that. So that order right there would be a 1 to 5, but I believe that that one is the limit order that we would potentially take if it comes back down. And our other order would simply hit for a 1 to 1.3. Now, if you guys watch, price starts to stagnate and then runs straight to TP. Now, it's not the prettiest order, but this is very simple just on how I can find one small move. This doesn't mean that I'm going to trade strictly off of this, but I'm showing you guys the power of this confluence. All right, guys, so here you can see another example where price actually respects the highs and then actually uses that to propel price further down, right? So here, if you mark this out as an order block, right, and you also look on your higher time frames to see how was price looking, you can see price started to build all this weakness over here, showing that there's strength with the sellers, right? And then you go down to your lower time frame and you can see price comes here, builds up, exits Asian session, and then breaks above and break structure towards the downside. So now we've broken structure towards the downside, and then we come in and retest. So once we break structure towards the downside, and I'm gonna show you guys exactly where that is. Here you can see you have high and your low right here, and then price breaks above, and then this is your new low, and then price breaks above again, and now it breaks below. So what I could do at this point is set my limit order right here, or I could be looking to get in right on the break. Now, I don't have anything against you doing both of them to try to, make sure that you're in the trade, as long as you make sure that you use proper risk management. So here you guys can see there's that, and I could set this limit right here. And then all I could be looking to target, at least as my first target, is the lows of Tokyo session right here for a simple 1 to 4 or a 1 to 13.5 if we pull all the way back up. So you guys can see the risk to reward on this strategy is nuts. And then boom, price already taps in that other order. And as you guys can see, it starts to sprint down, consolidates a little bit, and then essentially melts its way down to sweep the lows of Asia session. And then what I really want to point out to you guys is look at how it reacts after it sweeps the lows of Tokyo session. It starts to come back up. And that's why I like being precise with my targets. I don't necessarily want to catch this entire retracement. I'd rather get out and then get back in the markets if it shows me another entry. I hope you guys enjoyed this video. Let's get right into the next one. In this episode, we are going to be talking about the fundamentals of Forex. So to start off, I want to talk about two terms, hawkish and dovish. Hawkish essentially means that we are going to raise our rates for whatever currency we are looking at. It is like essentially a tone. If someone has a hawkish tone, it means that they're looking to be pushing for higher rates. Whenever you see higher rates, you're going to see price want to move higher up, because think of it like this. If your rate moves up, then your currency becomes more expensive to buy, making it more bullish. And if your currency is dovish, it means it is bearish, essentially. Dovish means that they want the rates to be cut. It is a sign that our rates are going to be pushed down, and honestly, it usually is coupled with a better economy. Now, I know what you're thinking. A lot of people are like, wait, why would a better economy mean that the currency is moving down? Well, it depends on what type of system we're focused on. So right now, because inflation is completely out of control, we need to see inflation get controlled better. So what is one way that we can slow down inflation? We raise our rates, making our currency hawkish, making it more expensive to buy so less people can buy it. So that's kind of how we slow things down. Now, the next thing I want to get into is the Federal Reserve, because this is the most important banking system in the world. Now, the Federal Reserve is consistent of the 1-3-5 system. That's what I call it. The 1 being the actual Federal Reserve. So this is the biggest and most important banking system across the world. Now, under the Federal Reserve, we have 3 main things. We have our Federal Reserve governors, we have our 12 Fed banks, and we have our Federal Open Market Committee. Now, the Federal Reserve has 5 main roles. The first one is to conduct the nation's monetary policy. So what this means is that they are in charge of setting our mandates for our interest rates. Number 2 is they help maintain the financial stability of the system, meaning that they want to make sure that our currency doesn't get out of hand, so that way our economy can continue to thrive and people can live healthy, stable lives. The third one is supervising and regulating financial institutions. So this is how we make sure that no banks are doing anything shady and essentially running off with everyone's money or doing something to rig or manipulate the markets in some sort of fashion. Now, the fourth one is fostering payment and settlement system safety and efficiency. Now, this is essentially how the banking system has created a check clearing system to make sure that nobody can manipulate checks and manipulate money around the world. And the final role is promoting consumer protection and community development, essentially making sure that money is being reflowed back into communities to promote healthy financial economic structures for them. Now, what I want to get into next is understanding what the financial system is based off of now. So if you guys look back then, you used to be able to go to the bank and exchange your US dollars for actual gold. The dollar used to be backed by gold. Nowadays, it's technically backed by faith. Now, this is why inflation tends to get out of hand, because we literally print money out of thin air. Now, a lot of people like to say, oh, some other currency can come replace the dollar. I don't believe that that's going to happen, because at the end of the day, we are the world reserve currency, meaning every single institution out there, when they want to transact, they have some sort of reserve of United States dollars. If something is going to happen, it is the most important currency. And not only that, technically we are backed by faith, but the United States has the largest military in the world, making that alone something that backs its currency. Now, we have 2 types of markets, risk on and risk off. So risk off happens when something major is going on in the world, such as a war or just some sort of massive economic event, kind of like the pandemic. So in risk-off situations, the economy is not looking to put money at risk. They want to save it because something in the world is going on that is scaring the economy. So in these moments, you're going to see 3 currencies move up because they're considered safe havens, which would be the Swiss franc, the Japanese yen, and the United States dollar. As well as you're going to see a lot of money flock into gold in uncertain times. Now, when we're risk on, you're going to see the dollar go bearish, you're going to see the Japanese yen go bearish, and you will usually see the Swiss franc go bearish. What you'll also notice is the stock market will go up and cryptos usually tend to go up as well. Because at this point, people are ready to put their money at risk and they are looking for that return. You know, everything is flowing smoothly, so they understand that they have money flowing out of other areas, so they're comfortable putting their money at risk. So now I want to show you how I use fundamental analysis to my advantage when it actually comes to trading. So the first thing that I do is I head to forexfactory.com. If you guys don't know this website, it is the website that will show you every single major news release that is going on in the world. So the yellow folder news is usually minimal impact, the orange folder news is medium impact, and the red folder news is high impact. So what I like to do personally is filter it by red folder news and then look towards the entire month. So whenever it comes to the charts, this is what's actually priced in. There is a reason why price continues to build its structure and go towards its areas. It's because these variables are priced in. So every single time we're going to have an economic release, we have a forecast and a previous, and then we wait for the actual result. The forecast is what we're predicting to show in the markets. The previous was our last release, and then the actual is how it actually comes out. For example, let's come back to Monday, August 12th and look at any Australian dollar pair at 9:30 p.m. Eastern Standard Time. So I'm going to change my chart to Eastern just so it's not confusing. And let's go to AUD USD. And we said it was Monday, August 12th at 9:30 p.m., right? So imagine you were looking at this order. What you can see here is price is resting in a decent little demand zone over here. Kind of looks like a small order block, and it might not be the most valid level. But if you actually look over here, you're going to see wage price index came out at 0.8%. The forecast was 0.9 and the previous was 0.9%. So in this scenario, you guys can see that the Australian dollar missed its forecast, giving us unexpected news. Now what this did was price released exactly at 9:30, and I want to show you guys exactly how you could have used this as some sort of confluence to your trading. So the release comes out at this candle right here. You can see it creates a little wick, and then price builds its structure off of that. Now what you guys can see is price starts to use the bullish order block that we're in right here, and it uses this data to propel itself upwards. Once we see the way that this candle printed, you guys can see price fully breaks structure over here with this candle closure, so you can decide to hop in right there on just a fundamental based trade. Now when it comes to picking our targets, we can go on a higher time frame, and obviously I can see that we're expected to clear this out, but this isn't even a 1-to-1 risk to reward ratio. But since I'm taking this based off of the fundamentals, what I can do is start to identify where is there heavy liquidity in the market. So what I can see over here is we built up this nice downtrending liquidity over here, as you guys can see that. And if I go on the higher time frame, you can see that even clearer, like right here. And then what I want to do is essentially find the level where the wicks are touching. So something like right here for a 1-to-3 risk to reward ratio. And what you guys can see is price literally sprints towards that take profit. Now this wasn't the most intense news release. The ones that you always want to watch out for are the US dollar news releases, especially when it comes to FOMC, NFP, and GDP. So GDP is gross domestic product, essentially showing us what's going on in our current economies. So as you guys can see right here, it is the change in total value of all goods and services produced by the economy, right? So essentially if goods are becoming more expensive or less expensive. CPI is our inflation, and NFP would be our non-farm payroll, essentially showing what the unemployment is looking like in the United States. Now, each one of these currencies has its own version of it. It might not be called the same exact thing, but all you guys have to do is click this little folder right here to see the actual definitions. So let's go to another one. Here you guys can see GBP claimant count change. This is their unemployment data. So our forecast was supposed to be 14.5 thousand, but the actual was 135,000. Now, if I see 135,000 people claiming unemployment, then I'm understanding that the economy is suffering. And understanding that the economy is suffering when inflation is out of control is actually a good thing, because we have to identify our current situations. We want inflation to go down. And if it's something good, that's going to be something that is dovish. So this is a dovish remark towards the market. And I can see this is when the news candle actually releases. So now I'm on my higher time frame, and I've already identified that I want to go bearish based on the news release. So now all I have to do is find some sort of bearish structure that I can play off of. Now, one thing I can do is pinpoint a target. If this is really going to move bearish, I know that price is going to do this, right? It's going to create a new low, a lower low. So I already have a target of this level right here. Now, I don't have any clear breaks of structure on the 1 hour, but I do have a very strong fundamental bias. So what I can do is go on my minute 15 or something and try to find a break of structure there. So what I can see is I broke structure towards the left side over here, which would then leave me with an order block resting right at the top over here. And you guys can see one thing I do like about this zone is I have this liquidity resting all right here. And if I have this liquidity, that's a very good target for something that could be swept, right? So I could have this liquidity over here that I'm looking to take out, and I could set my limits up here, but obviously I don't want to just get in on the limits. I always want to have some sort of confluence there. But if I set my limits, this would play for a perfect 1-to-8 risk to reward ratio. Now let's see how this candle moves. As you can see, price starts to kind of fluctuate towards the downside, almost even fake us out off this level, right? Because you guys can see price pushes down, actually taps into our zone here. And then even if I go down to my lower time frame, you guys can see it even breaks in on the minute 5 and gives us a break of structure. But the reason why I don't want to take that level is because if you guys look at these time frames, we don't have breaks of structures off this level. We have a break of structure off this top level, yeah, and it's only a weak level. But at least if I go on the higher time frames, it's still the most valid supply area for here. So you always want to get in at the best price, like we talked about throughout this course over and over again. But if I wait for price to enter here, you guys can see it taps in and it quickly rejects. Now what I want to do at this point is find out what's the lowest time frame that this is playing off of. Well, if I look left, I can see, okay, I have my minute 5 order block here. Does it touch right there? Yes, it does. It actually touches that. So now what I would need to do is identify where would my break of structure be. Well, here, if I had this high, came down to here, pull back, break there, pull back, break, continue up, pull back, and no breaks. So now my lowest point is this level here. And all I did right there was my real lows and real highs drill. But to me, it's already become second nature because I've been doing it for years. So all I want to do is identify a break, and you guys can see right there, it literally melts through on the US dollar news. And if I had been in already on the touch, obviously I would secure that. But let's just see how that US dollar news released. So you guys can see core PPI was at 0%, PPI was at 0.1, and that data drove this pair to melt. So you guys can see our take profit was absolutely smashed. And it's no coincidence that price reaches this zone right before the news, because the price is following what's happening with the forecast. It's pricing itself into the market. So you always want to identify with the forecast, where are our markets priced in at? And I'm going to get into that in the next episode. All right, guys, so now I want to show you how the markets actually price themselves in using the fundamental data, and how we can use that to our advantage, essentially to manipulate the charts and secure these huge risk to rewards at a very high win rate. So if I go to Forex Factory, I want just to find the upcoming news release. So the one I selected here is the GBP GDP, and you guys can see a couple hours after that, we also had core retail sales and unemployment claims for the US dollar. So obviously when this news is coming out, I don't have these numbers here because this is the actual releases. All I have is the forecast. So here I can see the previous was 0.4% for the GDP, meaning how the economy is essentially growing, the total value of all goods and services produced by the economy. So if prices are going up, then that means that the economy is thriving, meaning that we're going to have a hawkish tone. But in this case, we're having a dovish tone because you can see price is showing us 0.0%. So if we meet the forecast, or if we beat it by essentially losing, like let's say it came out at -0.1, then we're going to see a bearish GDP. All right, so here I'm going to pull up the exact candle where this releases. So if I go back to Thursday, August 15th at 2 a.m., you guys can see that's right there. And I'm just going to pull up replay mode into this area. So right here is the news candle where it releases, right? You can see that exactly over here. So right off the bat, you guys can see it prints a bullish candle. But I also understand that fundamentally, we just printed bearish data. We met the forecast and we're looking to price in for some sells. Now, if I look at the charts, I can see, hey, we don't have any clear breaks of structure here. What I can already identify though, is I have a lot of liquidity resting right here, as I can see by these wicks. And I don't have any clear breaks of structure on the 1 hour, but what I can do is try to find a lower time frame. Now, the reason why I'm able to find a lower time frame is because I have the fundamental biases with me. Now, if I start to look, what else is going to release today? I have core retail sales. Core retail sales, before we're at 0.5%. They're forecasted to come out at 0.1%. And then I have retail sales, which were recently -0.2%, and they're predicted to come out at 0.4%, meaning that they're increased. So these two are essentially showing some conflicting data so far. But I also have unemployment claims where it's showing more people are supposed to be claiming unemployment. So if I have more people claiming unemployment and I have my retail sales showing me that they're going to increase, but my core retail sales are going to decrease, I have to now look at the technicals and identify what's going on. So I already have seen bearish GBP data. Over here, I'm seeing 2 bearish for the US dollar and 1 bullish for the US dollar. But that's when I have to look at where are the charts actually priced into. So looking over here, All right, we've already identified that we have this. And if I'm looking to sell, this is going to be my most optimal area. This little supply zone up here. Now, if I go to my lower time frames, so here I can see on the minute 15, we did have a break of structure towards the downside right here. So I like that. Now, since I have that break of structure, I can start to focus on this level up here. And what I have to be mindful of is the timing of everything. So here I can set my limits at this area if I see it moving nicely towards there without any big massive candles, right? And if I'm understanding that we're going to move bearish, well, I have to think about it. If price is going to move bearish, and I'm on the minute 15, right, where I can see price to me already has printed some bearish structure. We had this, and then one pullback, a higher high, and then a lower low, lower high. And now what I need to see is a lower low get printed, right? If price is really going to move bearish, we're going to print a lower low. So I can already target this area over here. And that right there alone would give me a 1-to-8 risk to reward ratio. So if I go back to my minute 5, I can see, okay, price is moving, but I have to be mindful that at 8 a.m., right, 8:30 a.m., we're going to have US dollar news. Now, if I'm looking over here, I'm just going to put one horizontal ray exactly where that news is supposed to come out so I can make sure that I'm aware of it. So when price is actually moving, I'm seeing it start to slowly trickle towards the upside. But what I like is, all right, here it looks like it's going to go down, and then you guys can see it's starting to play back up. I really like that because what I can see here is price is almost faking us out here, trying to get those people who are looking to get in early enticed to take them out. So you guys can see right there, boom, price pulls back up, and then now it taps into that zone literally 30 minutes before the news drops. Now this is so big to us because if I'm priced in perfectly for the sell and I'm having conflicting data, but I already have GBP showing me that it's going to move bearish, and I have some sort of dollar news showing me that it's going to move bearish, and I look at the previous dollar news showing me that this pair should still be moving bearish, essentially everything is in a line there with my technicals, then I could be looking to sell this off, right? So I could enter the sells right there without hesitation, and if I lose, you know, I lose. But at least if I win, I had some sort of fundamental buys. Now here's even further conclusions, right? You guys can see price pulls back down, almost breaks structure in this realm over here. Now, if I try to find the exact time frame that price pulls into, then I can really identify my breaks of structure. So here I can mark up my minute 4 order block as this level here. My minute 3 is the same level. My minute 2 is the same level, and my minute 1 is the same level. So all of those are essentially the same level, right? I'm gonna go ahead and bring the charts back to where I was. You guys can see that liquidity get built up over there. Price makes its way back up, and then yeah, look at that. Price was touching on the minute 4 order block, and then we can see it comes up and literally tanks off that news release. And it was that simple. All I did was essentially identify some sort of that news being predicted in my favor, identifying the weakness, as in this is a bearish target for me because I've already seen the bearish GBP news, and I already see that part of the US dollar is expecting to come out bullish. Now here, it actually worked out completely in our favor because we had less unemployment claims, meaning that a lot more people are working. So that's bullish for the dollar. We had higher retail sales and higher core retail sales, showing us that the dollar was going to move bullish. So up next, I'm just going to show you guys another example so you guys can start to piece together how this really works. So here we have CAD CPI. As we talked about, CPI is inflation. Here we had the previous was negative 0.1%, and here we have the forecast at 0.4%. So here I can see the CPI is showing me it's going to increase. The median CPI is showing me it's going to decrease, and the trimmed CPI is showing me that it's going to hold. So right now I have conflicting data once again. So what I want to do is really identify where am I priced in and also use other data around it to help me. So I can obviously see that the week before we had the bullish dollar news, right? So I'm already thinking, all right, maybe I'm going to have USD CAD buys. That's one thing that's in the back of my head. And the day I said it was Tuesday, August 20th at 8:30 a.m. All right, guys. So in this moment here, you guys can see that the news gets released exactly on this candle over here, and it instantly gives us this huge spike towards the upside. But when we go to look at the release, we actually had CPI meet the expectations and hold. So that is bullish for the Canadian dollar in my eyes. Now, obviously we had one short and another short, which shows me that this is bearish news for the Canadian dollar. So right off the bat, I can see a bearish reaction towards the upside. But I still know that the most important one, our CPI, had shown me that it's moving bullishly. So if the Canadian dollar is going to increase in value, what I'm going to be looking for is sells from a certain area because I'm on USD CAD, and CAD would be the quote pair. So if CAD is appreciating against the dollar, then USD CAD would be selling off. So here, all I'm looking for is some sort of rejection in this area up here. So you guys can see price pulls back into this area, it's on that order block, and you guys can watch as price starts to reject. So here, it's not giving me any amazing confluences, but what it is giving me is price is already starting to heavily slow down. And if this is the area that is supposed to push us up further, then I want to see price essentially reject that zone and show me that this area is no longer valid. So here I've broken out of the last area that tried to push us up. So I could take some volume-based sell over here and look to target these lows right here. Now, as you guys can see, if this is my entry, I would let this play out. Price pulls back up, respects this order block up here, right? And I want to find the lowest time frame order block that it plays out on now. And this is literally just showing you guys the power of the order blocks. Like, if you guys wait for those order blocks, you can find such amazing entries. Like, so let's see if this touches on the minute one. So it actually does. So here it touches on the minute one. And if it touches on the minute one and I get in on that break, then this could be my entry right here. I could tuck my stops right there, and I could still be looking to use that same target. So now I already have one entry right here where I was trying to catch that volume-based entry, and then I have another entry up here. And if I try to identify, let's see if the minute one is the same time frame as any of these other ones, like in terms of order blocks. And so it looks like the minute one and the minute two are the exact same. Let's look at the minute three, not the same. The minute four, not the same. And the minute five is not the same. So the minute one and the minute two are exactly the same. So what I could do in this scenario is find a minute two order. So here you guys could see the minute two break structure at that same level right there. And what you could do as well is set your limits on that minute two order block, which would be this candle right here. So now we have 3 entries. 2 of them are sell nows and 1 of them is a sell limit. And each one of them, if they play out, is going to leave us with a very nice risk to reward. The first one being a 1 to 1.4, that one's all right. The second one being a 1 to 3, that one is very nice. And the last one being a 1 to 7. So if we let this play out, let's just see how it moves. I'm going to just speed it up a little bit so we can just kind of get the result quicker. But you guys can see now we're actually in current markets, and this has gone into another day. So obviously we have to be mindful of the results. But even if I were to just take it out at this rejection order block or something that's still 1 to 2.6, or where price is at now, that's a 1 to 2.5. This one would be almost a 1 to 6, and this one would be just a 1 to 1. So right there, literally just the patience and using the data and allowing that data to show us what the markets is going to do is how we can use the fundamentals to create such a higher edge and probability towards our strategy. So if we use this in couple with every single one of our fundamentals and technical analysis, then we can find the best possibility setups. So I'm going to show you guys one more example where I'm going to try to piece everything together so that way you guys can really grasp this concept. So I'm going to try to find another news which I had not used yet. So let's use the US dollar CPI because this is one of the most important fundamental releases that ever comes out. So let's go to Wednesday, August 14th at 8:30 a.m. and let's just go to GBP USD. And the reason why I want to use GBP USD is because you guys can see if I'm looking at the charts at 8 a.m., I already had that news for the Great British Pound already come out. So I can see we had bearish news for the British Pound where 2.2% was their inflation, but it's still also above their previous. So you guys have to see this is still kind of conflicting data. Yes, they beat their forecast, but economy still grew from the last time. So over here, I'm saying, okay, the economy is expected to grow, the economy is expected to grow, and the economy is expected to hold. So already I'm formulating that we might have a bullish dollar bias, and we had a bearish British pound bias. So the next thing I need to do is identify where are we priced in at. So here I'm gonna go to 8:30 a.m. on August 6th, and here we are. So here, if I'm looking on all my timeframes, I can see price is extremely low. And what I want to do is identify, are we in any daily or weekly zones? Yes or no? So far, no. I don't see anything on the daily. I'm going to take a look at the 4-hour. I don't see anything. And all I want to do is essentially look at what happens when our news gets released, right? So here, I'm not seeing any sort of structure that's screaming at me that I should take some sort of entry over here. The news was released right here at this candle, and you guys can see price pushed down a little bit and then honestly just kind of died out with the volume. Now, the one thing that I could say I see here is when we have this trend line break. Now, you guys can see when this news came out, I have the dollar showing me that our core CPI grew month over month, our CPI grew month over month, and year over year, we did come out bearish. So right off the release, that 8:30 candle, you guys can see price kind of comes down and then we break out of this trend line. So if price wanted to move bearishly, why would we already break out of this trend line? That's one thing that we have to identify. So once we get this very solid candle closure, and I wouldn't necessarily rate this one because it's not the most solid, it left this big wick and it almost closed below. So this one is really down to how you drew it. Like if you drew it like this, then it didn't close below. low, right? If you connected straight through there, then it didn't close above that. Now this one over here, you guys can see is a very strong candle closure. So this, just off the fundamental analysis, you could be looking to take this and looking to sweep the highs over here. Now, if you go on your higher time frames, you can see, hey, price, if it is going to start to slow down at a certain level, it would most likely be somewhere where we had wicks on the upside slowing down. So if I look left, I can see over here, this is where a lot of price had slowed down. So now if I let this play out a bit, you guys can see we catch a little bit of drawdown, we're hanging out in some drawdown, and then price starts to make its way towards the upside. Now, this isn't necessarily the move that I'm looking to take, because I do understand that I'm getting in on a minute 5 trendline break. Yes, I am using the fundamental bias in my advantage. So if I'm looking to just take it to this level here, I'm going to catch a 1 to 1.5, but I'm saving myself by giving myself a much higher possibility of winning, because I've let the news confirm that it's going to move in this direction. Or not confirm, because nothing is 100% guaranteed on the charts, but it's given me a very strong sense that this is the direction it wants to go to. But if I do let it try to play out to that target, then you guys can see ultimately it does stop out. But if we are playing our cards right, because we're not on any sort of higher time frame like daily or weekly or something order, I don't want to swing this. I just want to take this to that simple zone right here. Now, I just want to give you guys one last example, because I think that this is something that could really change your trading game. I mean, me going from making 10,000 a month to 100,000 in a trade was literally just based off of learning how to trade fundamentals. So I cannot stress enough how important this is. So let's go back to Thursday, August 1st on USD CAD, just like any, just a random pair, USD CAD, and see at 8:30 a.m. what's going on the charts. So let's bring this back to Thursday, August 1st, 8:30 a.m. So here you guys can see the news gets released for the US dollar. And then we also on that same day have ISM manufacturing PMI. So over here, it looks like the PMI wants to grow. 48.8 is the prediction, and the previous was 48.5. Now, anything greater than this would be showing us that manufacturing services are increasing and that the dollar would be moving bullishly. But you guys can see that one still comes out bearish. So here you guys can see that more people are expected to be claiming unemployment, meaning that less people are working. So if less people are working, then we're most likely going to be seeing a bearish dollar move into play. So here you guys can see the news actually comes out, and right away we follow it with a printed bearish candle. Now, honestly, when this news came out, I could be looking to find some sort of trade just based off of like literally simple things like this, like rejections off of these trend lines and just looking to ride this down to some liquidity. So if I were to look to take this order right here, then I could see, hey, I have the lows of it. Tokyo session, we swept the highs of Tokyo session already, and then price started to create this downward trend line over here on the minute 5, and it respected that along with the fundamental bias. So if I want to take it to the lows of Tokyo session, that could be an excellent target, and let's just see how that plays out. Boom, just like that little level gets smacked. Now, this isn't anything that I want to be looking to swing, because once again, if I look on the hour 1, I'm kind of in no man's land. If I look on the daily, I'm obviously not in any sort of selling position from that area, and you guys can see it actually ends up buying up afterwards. Now, all I want to focus on is some sort of way to catch a very high probability trade. So regardless of this being a 1-to-1 risk to reward ratio, the fundamentals have confirmed to me that this is going to be moving bearish. So I'm happy taking this 1-to-1, knowing that I can risk more on it because I have that much stronger of a bias and confidence behind this trade. I hope you guys enjoyed this video. Feel free to rewatch the entire fundamental series, because this is the most important part in trading, I swear to you. And thanks for watching, guys. Alright guys, in this episode, I'm going to be showing you how we can actually use the charts to show us if a zone is valid or invalid just by being a little more patient. Let's get right into it. So here you guys can see my chart. And the first thing I want to do is start off by drawing this diagram. So as we know, we like to trade when we have a breakup structure and an order block or a supply or demand zone, right, in the charts. So a lot of the times we don't know if this area is valid. And one easy way to figure this out is what you're going to notice is before entering this zone, you're going to see price essentially start to stagger back like this. Now, if price staggers and then breaks this way down, this means that we consolidated in this area here, right? Now, just because we consolidated doesn't mean anything yet. But what we have to identify is what this is telling us is out of this entire range, the sellers won. So if price is really moving bearish, there's no reason why we should break back into or above this zone. So if we see all these sellers end up coming back and breaking above, now this is a great confluence that this area is not valid for sells and that we're going to continue for buys. So obviously you're going to lose out on some risk to reward by taking a trade like this, but a lot of the times you can see this, even occurring all the way down here, which is a great confluence because we obviously want to catch the highest probability trades. your risk to reward is something that's very important when trading, but it means nothing if you just keep losing, right? Like obviously, you can win one and that can outweigh 5 losses, but you still don't want to take 5 losses. It's still very nice to be able to risk a little bit more because you have a higher percentage win rate. So obviously, I believe risk to reward is super massive because you don't need a good win rate. But if you start to couple all these habits, you're going to find yourself getting very good risk to rewards and very high win rates. So same thing would occur on the sell side, where the charts could, we could be moving bullish and then we break structure towards the downside. And once we're getting towards there, price could consolidate at some area and then push back up and then essentially break this level. Now, that break of that level is literally showing us that these buyers were just fake. Like they got manipulated, they had no real pressure, and that the markets are going to continue. So now I'm going to show you guys some examples on the charts. So here on USD CAD, you guys can see we have this bearish order block resting right here. And before price reaches this bearish order block, you guys can see we're starting to consolidate in this area over here. So for this consolidation, I'm just going to make it orange, right? Now, as you guys can see, price consolidates here. You can see it also very, very clearly on the minute 15. And what I want you guys to see is if price really is going to move bullish from this area, why would it enter our order block just to break back in, right? So this is obviously an area of a lot of sellers. So if the buyers are in control, then what you're going to see is the buyers are going to break the sellers and this area is going to be invalid. So one way that we could be patient and finding, like essentially confirming the structure, is by waiting for price to enter our order block and then come back into that last area where we saw buyers were in control. Because if it comes back into that area, then we know that the buyers are no longer in control. So as you guys can see here, price pushes up and then it instantly comes back down. So at this point, I could literally just look to sell, tuck my stops above this area over here, and then simply because I'm looking to continue this trend towards the downside, I already know if this is really going to move down, it's going to create a new low past this level. So that right there is a 1 to 2 risk to reward ratio, which isn't insane, but what you guys have to understand is I'm coupling this with fundamental biases to allow me to see this trade playing out better. So obviously I have this technical bias and I'm already coupling it with everything I have in my arsenal. And I can see over here, this zone is now showing me that the buyers are not in any sort of control. So if buyers aren't in control and I have my higher time frame supply zone over here or order block showing me confirmation towards the downside, I'm very comfortable letting this play out. And as you guys can see, price consolidates, you catch a little bit of drawdown afterwards, and then it continues, and eventually later on, you smack your take profits. Now, the beauty of these orders, in my opinion, is because you have such a high win rate with this type of style, you can be risking a little bit more. Nothing crazy, you don't want it to blow your account, but you could be more confident in finding these setups. So let's show you guys another example of this. Here, I'm just gonna pick GBP CHF, and I'm just gonna find like some random moment where you guys can see this example. So over here, right off the bat, right, I can already see price break structure towards the upside. Now you guys can see this was moving extremely bearish. There's nothing hidden about that. Price was moving extremely bearish. So us wanting to get into buys here could be looking risky. So I'm already trying to mark up my order blocks and seeing where is price going to play out on here. So I can see there it's not touching on the 1 hour, but if I mark up my 4 hour order block, I can see right there it is touching the 4 hour order block, right? So at this point, all I want to see is find like a lower time frame where price had just consolidated before here. Now, if I look over here, I can see the minute 15, it didn't necessarily consolidate. I mean, here you could say, yes, it somewhat did, but I want to see some sort of bigger area where it's ranging, right? But you guys can see price shoots its way downwards, breaks structure towards the downwards, clears that Asian low liquidity. And if we look even, let's just check the minute 5. Yeah, I mean, price does somewhat consolidate there, and now it's retesting this order block. But if the sellers are in control here, there's no reason why we should be breaking structure or breaking back into this level, especially considering that we just swept Asia lows. So if the sellers really are in control, then we shouldn't be breaking back into here, because then there's a very high probability that we're going to be breaking all the way above. Now, one thing that we can also do here is identify our dynamic liquidity, right? So if I mark this out over here, I can see, hey, we have all of this resting over here. So now if I'm touching in my order block and I break above this zone right here, then that's another way that I could very heavily find an order going towards my direction. So here, what I really like is price is now starting to very heavily consolidate, right? You can even see it over here. And I'm just going to make this blue to differentiate that this is our order block and everything else is just showing us consolidation. So if the sellers really are in control, then we should be seeing breaks towards the downside and no upward reaction out of our order block. Yet you guys can see over here, we have a break back into this level and above, a break out of this level and above, and now a break out of our dynamic trend line. So now if I just target the top of our trend line over here, and I can use the stop loss just under here, because when we break out of a trend line, I'm very comfortable using the lows, or I could use this if I want to be more conservative, which is the low of the entire zone. So those two orders, I'm just going to show you exactly how both of them would play out if I entered here and used the entire zone, and if I entered here and just used the previous low out of that trend line break. And then all I'm doing is targeting the liquidity resting at the top. This one would be a 1 to 1.65. This one would be a 1 to 2, and just letting it rip. So you guys can see right away, this honestly does give us some drawdown and breaks right under that again. And then you guys can see price actually makes its way back up. And so once again, the area where our buyers held from is now being respected again. So now that I've broken out of this trend line again, and I have seen that this area is being held again, I could look to hop in for another buy position right there. Now, obviously, I'm not looking to risk my entire account or risk anything crazily aggressive on these, but I'm just showing you guys all the opportunities. That's why I'm showing you exactly the moments where you can buy in, because even if I miss the first or the second entry, I'm gonna have an opportunity to catch the third. And even if I don't take the third, I would still rather be the guy who missed those 3 wins than have taken 3 losses across this trade. So now we can see price retest this trend line, and now it's continuing towards the upside, consolidating a bit, rejecting a little bit, and let's just see how this ends up playing out. And boom, you guys can see price absolutely smashes take profit there. So I'm going to bring up one last example on this so you guys can really start to understand this, and I hope you guys really piece this together. Feel free to watch this video as many times as you need, as well as every single video in this course, because this strategy, I swear to God, guys, if you guys get it down, will completely change your life. So here I'm on Euro AUD, and all I'm going to do is point out, for example, this zone over here, right? So you guys can see price had pulled us up towards the upside, and on the hour 1 we don't get a clear break of structure. Now I go to the minute 30 and it's like, okay, I do have a clear break of structure. So I could be identifying this order block here on the minute 30, and the way that I want to confirm this order block is by waiting for that reaction out of it, and essentially the same setup that we've just shown you on those last 2 trades. So here I'm waiting for price to pull back down, essentially consolidate, which you guys can see it's already doing right here, right? So here is where these sellers are now like looking to gain control further. This is where the buyers and sellers are fighting. And now let's see, you guys can see the buyers get faked and then the sellers show that they're in control here. So now we're in our order block, and once we're in our order block, you guys can see right away we break back super aggressively into this area. Not only that, but you guys can see we have very clear breaks of structure after touching our minute 30 order block. So here we have a break of structure towards the downside. This is our new high, another break of structure towards the downside, and then a break of structure towards the upside. So now we have a couple options that we could take here. Now we could set a limit order at this level over here and tuck our stops under. And since we are looking to move bullish, we could just be looking to take this all the way up here for a 1 to 3 risk reward ratio, or we could be getting in right on the entrance of this essentially consolidation zone that we saw price slow down at. And then our stop losses, again, we just want to use the safest zone that we possibly can, and that one would be for a 1 to 1.6 risk to reward ratio. And as you guys can see, we don't end up getting tapped into the zone, but if we enter on that buy just based off this pull back into our consolidation zone where it's invalidated our sellers, we absolutely smack our take profits right there. And then you guys can see, obviously, the reaction after we smack our take profits is price reverses. And that is not a coincidence in the market. There's a reason why we have to stick to our take profit levels, and that is because that is where price wants to magnet to. I hope you guys enjoyed this video. Thank you so much for watching. Alright guys, so in this video, I'm going to be showing you how we piece together all of our fundamentals in order to build an A+ setup or a very high probability trade. And let's just see exactly how these play out. So I'm going to have my confirmation list on my screen, and I'm just going to have this saved to the side. Obviously, you guys won't be able to see it. If you guys have this in your notes, then you're going to be totally fine. So when I actually head to the charts, this is exactly what I'm going to be looking for. So you guys, if you don't already have this written down, make sure to screenshot this and make sure that you always have this within reach. So for me, I have it right in front of me right here, and I'm looking at my chart over here. So whenever I'm trading, I actually know what I'm looking for. So this was an example that we had already gone in a previous video. So I'm just going to pull out a random pair. If you guys look at EuroCAD, we had this order block resting up here. Now I'm just going to hop on the replay mode just to show you guys exactly how this looks. Now within this order block, if we go down on our time frames, we can start to refine this order block. Now this is already my first step. So here I'm just going to apply this and put bearish zone / order block. Now right off the bat, I can see, okay, let's see if this touches on the hour 4 time frame, right? So I can see it doesn't actually reach all the way to the hour 4. Actually, this is the order block. And then you guys can see from here, this one gets played into with that break of structure right there. And then it leaves us with this order block over here. So from this point on, I'm just trying to find out what's the area where we can play into. So I can see this is going to be the highest point that price reaches, and that doesn't line up with my 4-hour order block, right? So now another way that I could try to piece together a trade over here, because as you guys can see, once I go right, we're not going to see anything else, is by identifying a trend line break. So here I can see we have this huge dynamic trend line over here, this dynamic liquidity. So this is another one of my confluences, right? We have dynamic liquidity on the 4-hour time frame resting over here. And now I'm inside of this order block. So what I would want to see happen is price break under here with a very strong close. Essentially, I want to see something like this happen where we retest that and then we break under so I could tuck my stops right above here. But I'm just going to stay patient. Now, another thing that I can see on the higher time frame, because keep in mind, we are playing off of the daily here, is this area over here did have a nice fair value gap resting over here. So that is another confluence right there. And then you guys can see all of this liquidity that was resting over here, which later then got swept. So we had all this liquidity over here get cleared. And I'm just going to change this to black so you guys can see it. So we had the liquidity get cleared on this line. We had a fair value gap right here. We have a bearish order block on a higher time frame. And now we have dynamic liquidity right here. And now if I look on my lower time frames and I try to find some area where price had consolidated into to push further up, I can see here, for example, price over here breaks Asia highs and it consolidated before Asia highs and into Asia session over here. And I'm going to make this area orange. And then we break above and we have a clear break of structure towards the downside once we break this candle over here. So if I wanted to take an aggressive entry, let's just see how many confluences I have here. So right now I have the Asia highs getting swept. We're in a higher time frame order block. We already swept liquidity to go to the upside. Now we've also swept the Asia highs, and we've also broken structure towards the downside. So now if I take a sell over here, and because I want the highest probability order, I am going to tuck my stops right there. And I understand that I have this dynamic liquidity over here, this dynamic trend line. So that's going to be my target for this trade, right? Because I only want to take it to where this is going to touch. And then if we break, I can get in on another position. So here you guys can see price starts to move. Well, obviously you guys have already seen that price moved, and then price makes its way down. And now we've touched over here. And so you guys can see right here, we smack a 1 to 1.8 risk to reward ratio. And what I want to see is price essentially give me a strong break under here. But the only thing that I don't like, I mean, okay, here you guys can see price closes under, but I didn't get that significant of a pullback. So what I would want to do from here is wait for price to essentially retest the opposite side of this and then show me some sort of confluence that it's going to go down. Now from here, I could do that same thing where essentially if price, when it was on its way upwards, started to consolidate like this, you know, and then give me some sort of retest right here and then break back into this level, then I would be very valid on some sells and then tucking them just right above this stop right here. So let's see how this actually plays out. So I'm going to let price do its thing here, and you guys can see it breaks above, breaks below, and then now it's like wicking. It looks like it's essentially retesting this level here. So now at this point, I have enough structure to the point where if I get a solid candle closure under here, I'm willing to take this to go short. But now you guys can see price clearly breaks back up. And that honestly to me is probably just because if you go on a higher time frame, it's going to end up being a wick. So you guys have to understand this is very heavy on the daily time frame. So I mean, the daily never gave us that clear of a break. The only reason why this candle was under it is because that day opened up to the right. This one didn't necessarily close below it. So that's one thing you always have to pay attention to. So now let's see if we get another chance presented to us. All right, so at this point, you guys can see that price is heavily consolidating over here. And what I want to see is price break under this level before I get into anything, or play off of some sort of order block. So I still have this order block over here, which could be valid. And I would want to see price essentially push into it and then break back under, or for price to break under this level, right? So let's set this to a bearish zone, and I'm just going to let price do its thing. So here I can see price clearly breaks under this. And the only thing that I don't like about this order is that it's essentially in this push zone. So I don't think that this push zone could play out that well. And I would honestly want to see price still be tucked above this order block, because this is a lot of liquidity that still could be swept before entering an order block. And keep in mind, when we're traders, we want to make the most amount of money. So we want to get in at the best price. If I'm going short on the market, I want to get in as high as possible. So I still think that this is a very valid order, considering how much liquidity we built right here before this consolidation, and then we break towards the downside. But if you do want to get into here, I think tucking your stops right above there is still valid, especially considering how big of a move you could be targeting, right? So you could be still looking at a 1 to 2 over here very comfortably, almost a 1 to 3 if you take it all the way down. And let's just see how this starts to play out. And even guys, honestly, if this were to pull back up into here and then break back into the zone, I think that this would be like the perfect trade, right? So you guys can see price starts to do its thing. We do hit drawdown right away, and then it kind of holds in that zone, it looks like. And then price starts to build its way back up, sweeps Asia highs, and then rejects very heavily out of our order block. So right there, you guys can see we have a sweep of Asia highs, the consolidation fails to break towards the upside and it breaks towards the downside again. And then we also have the liquidity getting swept from over here. So if I take an order from right here and set my same target, and now I'm sharing that order block level as my stop loss, now I just want to see how this plays out, right? I'm gonna have to fast forward this obviously because this is a very big move, but you guys can see it looks like as fundamental releases come out, this trade pushes in our direction. And this is why I like trading on the higher time frames, because you guys can see this is a 1 to 6 order and this one right here is a 1 to 2. So just like that, we've caught plus 8R just off of being patient and combining our confluences. So let's go look at another pair and find another example with this. So here's Euro USD, and I've just cleared out all my drawings on this pair. So right off the bat, I can see we have this order block resting over here. It's very clear that we have this order block. And then up next, I'm just gonna start going down my confirmations list and trying to see what I can find in the market. So over here, I can see we don't necessarily have the best fair value gap, but on the 1 hour, we do have a fair value gap. Honestly, it's nothing major, so I wouldn't really be anticipating that price had to fill that in. But another confluence that I do see is this liquidity resting right over here. So this, in my opinion, this huge wick is an area that the markets are going to want to sweep. And you can even see all these wicks in alignment. So you guys can see very clearly price does come into there and it does sweep it, right? So I want to bring this back and just show you guys exactly how this would play out. So one thing is over here, you guys can see we also have the lows of Asia session getting swept. So that's another confluence because now we can look to be targeting the highs of Tokyo session. Now I want to refine this order block to a lower time frame, right? I'm going to go to my minute 15 and I'm going to start drawing out my refined order blocks. So this is my minute 15 level right here. And then I'm just going to be going all the way down to my minute 1 essentially. Let's take a look at the minute 5. And the minute 5 is all the way down here. And so I'm going to stick to those two for now because I don't believe that it actually will drop all the way to the minute 5. It's based on this order. So let's just see how it plays out. If it does drop to minute 5, then I'll mark out my 4, 3, 2, and my 1 from there. So from this point on, we're touching the minute 15, meaning that in order for me to get a break of structure, I would need to see price break above this level here, right? So I'd be waiting for break of structure on bullish. And then you guys can see, oh, we actually do touch our minute 5 order. So since we touch our minute 5 order, you guys can see it still is going to be that same order block right there. So from this moment, I have two options, right? I can get in right here and I can tuck my stop loss at the bottom over here. Now, another thing I want to point out is we did have this dynamic liquidity get broken towards the upside. So this right here is a great confluence, but I'm still trading in line with the hourly order block. So I could be looking to take this much further up. Now, if I look on the 4 hour, I can see this zone still holds on the 4 hour. If I look on the daily, I can see this zone is still valid on the daily. And if I look on the weekly, this isn't really a zone on the weekly, but I can see how valid this zone is on the daily and everything else from the downwards. So it still gives me a lot of confluences to take this trade. Now, another thing I want to point out on this trade is if you guys had seen when we were on the minute 5, right? Because now we have to choose the minute 5 to play into. You guys can see price had consolidated over here a little bit, and now we broke back into that level. And even price consolidated in this area just a little bit, and we broke back above those levels. And so now we're looking at all of our confluences. And one thing that I do want to point out, guys, is we haven't swept Tokyo highs in 1 day, 2 days, and 3 days, which means that we do have a lot of active sellers in this market. So if we just had this trend line break right here, what I want to make sure is that price doesn't reverse on me when I'm in my order. So I want to be pointing out a rejection order block resting over here, because if price is really moving this bearish, then I want to be cautious and make sure that I'm not taking any unnecessary losses. So when I actually trade into this level over here, I think that it would be a valid point to move my stops to break even. Now, the reason why I value that as a stops to break even point is because that is an area where my trade could potentially become invalid based on 3 days worth of data. So I have a lot of selling data in the market. So now I can look at it as, okay, maybe I don't want to be in this for the buys if I'm in an area where it potentially could sell from. Now, there's nothing wrong with getting stopped out of break even. If I were to get stopped out of break even on this trade, I can still find another entry if the trade is truly bullish. I can potentially miss a win, or most importantly, I can save myself from taking a loss. So here we go. We're going to see how this plays. Boom. Now I'm in that level. Now I would set my stops to break even, and then it tanks down, it pushes up a little bit more, and then right there it would tap us out at break even. But let's just see how this one would have played out if it continued to go. So you guys can see, and then boom, the entire zone ends up failing. So despite having all these confluences, we can see that markets were still extremely bearish from previous data. And yes, this could have meant that we could target it towards the upside, but this time it didn't work out and we were able to avoid taking a loss right there by simply moving our stops to break even. So now I'm just going to pull up another one just because I really want you guys to understand these concepts. So first thing I like to do obviously is start on the daily time frame. All right, so here you guys can see USD CHF had broken structure towards the downside on the daily, right? And so from here, I would mark up this zone right here. Now, this zone looks excellent on the daily. Now, the next thing I want to do is mark up that same zone on the weekly. And I can see on the weekly, this is still a nice supply zone. There isn't necessarily a break of structure, but because how rare a weekly candle closes, obviously it takes a full week. I'm not that hell-bent on finding a break of structure. I'm more comfortable with taking just a wick like that or a big push down as its own thing, as long as it's a break of structure on the daily. And you guys can see this level breaks this structure point, and it also breaks this structure point, showing how strong it is here. Now, if I want to point this out, I can see, okay, in the chart over here, I have a fair value gap resting right here. So this is an important area where price is going to want to move forward to, right? And then I can see price is starting to build liquidity as a target down here. So it's another area that I would really like. And there is no bullish order block that price is moving off of here. It's just simply building liquidity. And since there is no bullish order block that we're playing off of, it's giving me some sort of confluence that markets are now just retracing to get us in at a better price. So here I would then go down on my time frames and find out the lowest time frame that I'm playing on. So here I can see, okay, this is the hour 4 time frame. So if I need a structure break on the hour 4, it would be back down over here. And then let me mark up my hour 1 order block, see if maybe we're touching on that. So my hour 1 order block would be this level right here. And if I bring this to current data, right, you guys can see nothing has been touched yet. And the charts start to consolidate, and then it starts to break towards the downside. And so now I can see here, Asia highs get swept, markets are moving their way down. If I wanted to take some sort of rush trade, I could, but I'm trying to stay patient on this setup. And you guys can see here, look, that's exactly where the patience pays off. Right now, we just wicked into our zone. Now we've touched on that 1 hour order block. And I want to cross-reference this with my other time frames to see what exactly are we playing off of. So here's the minute 15, and I'm just going to start to wait on the 1 hour time frame. Or let's check the minute 30 as well. And you guys can see this is our minute 30 order block. So whichever one of these it is playing off of is what I'm going to be looking for my next confluences on. So here I can see we touched on the minute 30. And one thing I want to point out, guys, is price over here created this dynamic liquidity. That dynamic liquidity gets broken, retested essentially, and then a strong break towards the downside. So now all these confluences in line with how strong this level is, right? This is a daily and a weekly zone. So I'm already very confident in that level. And now I have all these confluences. So now if I want to target this, I can go all the way back up to my daily time frame to find my target. And like we said, we would be targeting this level over here. Now this could be some sort of a swing trade that we would be looking to take in the markets. And because of how strong the confluences are and how high of a time frame our biases are on, most of the time we will be priced in with the fundamental releases. So this trade is most likely not going to move against us. And actually with every data release, you'll see it more like a catalyst pushing us towards take profit levels, right? So here you guys can see the markets make their way down. Boom, it's kind of pulling back. There's a news release, and you guys can see how aggressive it's moving us towards our areas. And then boom. So I want you guys to take a look at something which I'm going to point out when this actually like reaches its take profit. If it does, right there. Okay, so this entire move from this level here took 19 days to set up, right? But in order for it to get this massive drop towards the downside from when we entered, it only takes 1 week. So it takes 1/3 of the time almost just to make its way down versus making its way up. So you guys can see here, this first initial move happens in 1 day. And if you guys were to trade into this level of liquidity, which is totally fine, right? You would have smashed it in 1 day. If you guys held, then you would be able to hold this all the way until down here for a 1 to 5.4. And since you have such a high time frame bias on this order, you could have used a higher risk percentage on this trade. Now I'm going to show you guys one last example so this can really click for you, and feel free to watch this as many times as you guys need to. Now here we are on Euro CHF, and you guys can see very clearly the daily time frame break structure over here, and then it ends up pulling back into this level right here. So this is going to be a bullish order block for us. So I'm going to put my bullish zone. So this was a little fair value gap on the daily, and you guys can see price ends up tapping into it on the next day. And then what I really like is that we had all of this liquidity resting right here on the downside. And then we also now left all of this liquidity on the upside to then be taken. Right? And one thing I want to be aware of is it does look like we are kind of making this dynamic liquidity towards the downside. I want to make sure that when I'm actually taking my orders, I'm not getting caught up in that. So this looks like it's going to be a very high time frame order, because if I start to play this out, I can see price doesn't necessarily give me too much into my zone there. But what I do notice is price here, right? You can see we break towards the upside, then we break towards the downside, pull back, and break structure lower. So now on the daily, I'm setting up for this break of structure. And if I want to hop in right there and look to take this to the end of the this trendline liquidity, then that's a 1 to 1.5. Now, the reason why I'm not covering this entire zone is because this is a daily order, meaning these candles over here have so much more significance than if it was anything else. So if I'm using this cover over here, this break of structure, well, keep in mind, this over here creates a new order block at the bottom level over here, right? So I don't want to use this entire candle because it's just going to look ugly, but you guys can kind of see what I mean right there. Now, the next candle, as you guys can see, holds off for a bit, holds off, and then we break above that dynamic liquidity. And you guys can see price starts to reverse a little bit, and then we pull back up and smack our take profits. So I hope you guys really learned something from this video. Make sure that whenever you are trading, you use every single one of your confluence lists. If you guys have any questions, don't hesitate to reach out. Thank you guys for watching. I hope you enjoyed this. So guys, just to make this easier for you, I made this little slides where you guys can see every single confluence that we are going to be using when it comes to trading. So this is the confirmation list. Screenshot it, write it down, or do whatever you need to just to make sure that every single time you step on the charts, you have this. I hope you guys enjoyed this, and if you did, make sure to like, comment, and subscribe, as this helps me a ton across this journey. Also, don't forget to join the free Telegram, which I'm gonna leave the link in the description, and also I'm leaving a link in the description to the best broker out there. If you guys sign up with my link, it automatically enters you into a $10,000 trading contest, $5,000 every single month towards the biggest percentage gain, and $5,000 towards whoever makes the most profits. Make sure you guys revisit this as many times as you need, and also do not forget to share this with a friend. But guys, that's all for today. I hope to see you in the next one.